So I think people often, kind of ignore proven winners or companies that have already done well simply because they've already risen by a large amount over time, and they ignore it and want to find the next shiny new thing. But I think that oftentimes the next shiny new thing is actually the old shiny new thing. Especially if, their businesses still have tremendous runway for growth. Now, of course, there are companies where, say in the first 20 or 30 years of their lifespan as a public company, they may have compounded their revenues or cash flows at 20 or 30%. And because they have kind of run out of room to grow, their rate of compounding in terms of their revenues and cash flows have declined to, like the low single digits. In that case, then, the next Amazon isn't the next Amazon. But then there are also special cases where even after compounding their business at 30% for the past 20 or 30 years, they are still able to do so over the next 20 or 30 years.
Correct.
Right? And if that's the case, then the next Amazon is Amazon.
Great. Before we begin the podcast, have you gotten your free ebook? It's called the Build a Six-Figure Portfolio Guidebook. Now, inside it, we share with you the tips and tricks to bring your stock investing skills to the next level. The best part, it's only 10 pages long and it's totally free. Whether you're on Spotify or YouTube, the link to download is in the description, or you can go to www.firl.co/free or www.firl.co/free. Right, everyone. Welcome back to the FIRL podcast, best place for long-term stock investors. How are you doing, John?
I'm good.
And I'm sure we are all going to feel even better after this podcast because we have a very, very special guest today. I know all our guests are special and interesting,
Yeah.
but I have to say that the guest today, why we've decided to brought him on was because, one, really good writing.
Oh yeah, fantastic.
Right.
It reminds me of Morgan Housel actually.
Yeah, you guys know Morgan Housel, right?
Yeah.
And someone with a track record. That's what I like.
Exactly.
Right? And so just to give a brief introduction to our guest today, right? And of course, he's going to explain to us in more detail what he has done and all that. He started off his career at Motley Fool as a writer for 7 years, right? And guys, Motley Fool is not like your average business magazine or your business columnist kind of newspaper. It's a legit, really, really great outlet for a lot of investors to source investing ideas in the stock market.
And they have a proven track record as well.
Yeah, many, right?
Yeah.
We talk about with Eugene, I believe, in the older podcast about this. Currently, he is the portfolio manager of Galilee Investment Management. So he's, again, yet another legit fund manager on the podcast. And what's interesting and what caught my eye was the fact that he ran a website or a blog where he shared all his thoughts, and he actually had a fund where he shared the results publicly that he managed for his family that compounded 19% for 7 years. You know who else also compounded at 19%?
Who?
Warren Buffett. But of course, not 60 years lah, right? Not yet.
You shouldn't say yet, Not yet. His story is not finished yet.
So I would like to welcome Mr. Ser Jing to the podcast. Hello.
Hello, thanks so much for having me. Really looking forward to sharing to answering or sharing any insights I may have to the questions that you guys will be posing later.
Is this your first podcast? Don't mind me asking.
No, I've done similar ones with other people before, so this is not my first try.
Damn, okay.
Yeah, we wanted to claim the first, but
yeah,
too bad.
Well,
Someone beat us to it.
Too bad. Not a podcast virgin.
Yeah.
Okay. Yeah, I think definitely the first question will be ask everybody the same thing is how do you actually get interested and started with investing? I really want to know that.
Sure. So actually, the story can be traced back to when I was about 17 or 18 years old. So I'm currently 34. So back then I was in junior college, and so I grew up in Singapore. So I studied at this educational level called junior college when I was about 17 or 18.
JC, right, for short.
JC, yeah, that's right. And I took economics as one of my subjects. And I remember back then in class, I thought that a lot of the theories that were being taught in school did not sound right. Like they did not reflect reality.
Can you name
And
one?
so
Can you name one, please?
I remember.
Call your teachers out.
So I think one of the key ones was that if people have excess money, they invest in bonds, right? And I thought that isn't right. Like every person that I know of, when they have excess money, they do not buy bonds. They buy everything else but bonds.
Yeah.
So I wanted to kind of look for people who worked with money and kind of understand how they actually thought about money. And then that led me to people like Warren Buffett and his peers and mentors. And I kind of came across Benjamin Graham, and I wanted to buy one of his books, which was the Intelligent Investor. So that's one of the famous books that he wrote. But back then there was no smartphones were not common yet, and so when I was at a bookstore, I kind of forgot the title of Benjamin Graham's book.
Okay.
And I had no means to search for it, right? So I ended up purchasing this other book that had Warren Buffett's recommendation on it. And it was Philip Fisher's Common Stocks and Uncommon Profits.
Another classic.
Yeah, and I thought that with Buffett's recommendation on it, that had to be the right book. So I bought it. I came back home and I was like, hey, no, that is the wrong book. And I started this journey. I started going to this rabbit hole again of discovering who Philip Fisher was and so on before I started reading the book, because I wanted to make sure that whatever book that I'm reading is legit, right? And so I found out that Philip Fisher is kind of like the real deal, and so I started reading the book, and nearly everything in it made sense to me, and so that was my very first introduction to what the stock market is, and so I got hooked, and so my interest in investing was kind of there in my uni days as well, but it kind of waned a little too. It was only until my year when I was in year 2 or 3 in university where I decided that I really wanted to make investing my career. Yeah, and I also wanted to be in a I wanted to be in a position within the investment industry where I could make a real positive difference to people's lives.
I see.
So yeah, so I kind of naively identified 2 organizations that I really wanted to work for. One would be Berkshire Hathaway, and the other would be the Motley Fool. So in 2010, I came across the Motley Fool as a customer, and through my interactions with them as a customer, I could really feel that they believe in their mission of wanting to help the world invest better. So that was their mission back then. Today is to make the world smarter, richer, and happier. So still two really great missions. But back then it was to help the world invest better, and I could feel that they were very sincere about it, and I kind of I could also tell that they really knew what they were talking about when it came to the subject of stock market investing. Yeah, so those were the 2 organizations that I really wanted to work for. And as luck would have it, in 2012, the Motley Fool in the US started this thing called the blogging network.
Okay.
And so they wanted to attract people from outside of finance to write about investing. And I was in my final year in university back then in 2012, and I thought, hey, I'm still a student. Why not give that a shot? If I write something and they like it, they would publish it under my name and pay me for it. So I thought it was a pretty good deal.
Okay.
So I started writing for them, and they really liked what I was doing. And after a few months, they invited some of the better writers they found through the platform to HQ, which is still currently in Virginia in the US.
Yep.
So they invited me in 2012. I flew over.
Wow.
And they did not expect to attract anybody from outside of the US. And when I was there, they realized that there's this weird Asian kid there who's obviously not from the US. And when they realized I was from Singapore, they were really excited because it was back then when they were kind of seriously considering bringing the Motley Fool into Singapore. Yeah. And so when I came back, they got me in touch with the team that was trying to bring the Motley Fool into Singapore. And so in January 2013, I started with the Motley Fool Singapore. So I was there all the way till October of 2019, when the company closed down. Yeah.
Is that where you met
the Singapore office? Yeah.
Is that where you met our close friend Stanley?
Yeah. So I met Stanley way before he. I met Stanley after I joined the Motley Fool Singapore, but before he joined the company.
Oh.
Yeah. So we were part of this. Or rather, we still are part of this informal investment club called Kairos, and it was set up by Stanley and 2 of his other friends, Willie King and Man Hong.
Yeah.
Okay.
And so I joined the club and got to know the people within there well. And when the Motley Fool Singapore wanted to expand Stanley just happened to be interested in it as well, and so he came on board. Yeah.
I see. It sounds almost like the PayPal mafia, because now I just saw David Kuo. Dr. David is also an advisor to you guys, so it's like I don't know. Would you consider David Kuo like the Peter Thiel, and then the rest? You just take your pick, like Reid Hoffman.
I like the PayPal mafia, but I don't think we are that similar. Yeah.
Okay.
Right. So what I find interesting about your journey is like both typical and non-typical at the same time. What I mean by that is that actually you can even make the argument that you skipping the intelligent investor somewhat and going straight to Philip Fisher actually became more beneficial, because a lot of people who start with intelligent investor start becoming, start to calculate and
very
do
quantitative,
pure balance sheet analysis.
Net.
And then they have to take 3 years to realize that doesn't really work anymore. And then they hop onto the Phil Fisher style, qualitative research. But you get to skip that altogether, right? So, my question is, having read that book first and then after that joining Motley Fool so early on and for so long, right? What have you learned from that?
Sure. So I did read The Intelligent Investor after I came.
Keyword is
after. After. Yeah, but I think that there are a lot of useful lessons found in The Intelligent Investor.
Of course. Yes.
It's a fantastic book. So I think your question is more on like what were my key takeaways from the book and from my time in the Motley Fool, right?
That's right.
So I think the one of the key takeaways that I found from both the book and the Motley Fool would be that great things can happen if we manage to find the right business leaders. If we manage to find business leaders who are innovative, who can think about the world in a different way, then these guys can build phenomenal companies. And if we have that kind of patient, long-term mindset of being a business owner, then we can be partners alongside these fantastic business leaders and reap the rewards over time.
Okay, very good point, and I want to dive deeper into that, Ser Jing, because we had the Adam Newmans, we had the Elizabeth Holmes.
Yeah.
How do you differentiate the wheat from the shaft, and what are the qualities that you can find to differentiate those that are a lot of fluff and hype versus those that are really, really fantastic quality business owners and capital allocators, actually?
Yep. So first, I think that in my personal opinion, I think it's nearly impossible to fully eradicate the chance that we may end up with investing in a fraud.
Yeah.
Right. So in my case, how I protect myself from that would be to diversify. So I have a kind of a relatively diversified portfolio. In the fund, currently we own about 47 companies. Right. So that's one way that I try to protect myself from potentially investing in a fraud. Now, the second thing is that I think it's also important to understand the business model of the company. So in the case of, let's say you talk about Adam Newman, right? He was building WeWork. So when I was looking at WeWork, I just could not figure out like how WeWork could achieve good unit economics in its business, right? So oftentimes, I'm not averse to investing in companies that are making losses or that are burning cash, but I need to be confident that that the cash that they are burning today is to be investing in something that has a very long lifetime, that has a very long useful lifetime. Example, like if you talk about, say, software as a service companies, right?
Yeah.
They tend to invest heavily upfront to capture customers that have a very high lifetime value, assuming that the software is useful, right? And they're investing in building great software that these customers will be using year after year. And so they are burning cash upfront to be able to build like an asset that has a very long, there's a lot of economic value that could be monetized over time.
Yes.
Right. But when I look at Adam Newman's case, or rather WeWork's case, I just could not figure out like what he's trying to build. Like, because the companies, or rather WeWork's customers, are signing short-term leases with the company. I mean, I also have to say that I'm not that familiar with WeWork's business. So whatever I say may kind of be inaccurate, but from my understanding, they were most of its customers were actually signing short-term leases with the company. So it's kind of like, you have this very short-term relationship with WeWork, and I don't think it was building something that had like a useful lifespan for monetizing over time. So I just could not understand like the business model that WeWork was trying to build.
I see.
And in the case of like an Elizabeth Holmes, who was I think linked to Theranos, right?
Yes.
This a machine that was trying to build like a
Blood
kind of
testing,
like
right?
like a machine that could diagnose all kinds of diseases in a very convenient
a God pill.
way. So I think in cases like this, it might be a lot harder to determine if if she is the real deal or not. And I think a lot will probably have to depend on like the investor's level of technical knowledge, right? I think like developing some form of technical knowledge could potentially help determine if like the technology that a company says it's building, whether or not that is actually true. So I think having that trying to understand the science and the engineering behind that could potentially help, I think. But I would think it's actually pretty difficult. I mean, like, in our portfolios, we have this company called Illumina, which makes DNA analysis machines, and it wants to acquire this company called Grill, which claims to have one of the best DNA
sequencing.
Blood test for cancer detection.
Okay.
Right? So it claims to have one of the best technologies. It's sometimes really difficult for us to know if that is true or not, right? Yeah. So I think in general, I think it's just in like the case of like a Theranos and Elizabeth Holmes is probably a lot harder.
So that's maybe like trying to figure out management, the negative sides, right? So when you look into a stock today, like what are the things that you really want to look at in management? There's obviously a lot of things, but what are the key ones that are deal breakers to you if they don't have?
Deal breakers meaning that if I see something that they do, it would make me not want to invest in them.
Yeah.
Yes.
Or if they do something, then you're like, okay, this is a good target.
Okay. Right. So deal breakers in both the negative and positive
correct,
sense. Sure.
correct.
So
Deal
in the
breakers
negative
and deal makers, I guess.
that's a good way. Yeah, so I think for a deal breaker, I think it would really be if I find that the company is treating shareholders very unfriendly in a very unfriendly way. So for example, like if it's if say its family members are in the company and it's getting paid huge salaries for not doing much work, for example, or if they're like very high levels of related party transactions that I don't think are fair, right? Then that would be, I think, a huge deal breaker for me.
Okay.
For deal maker, I think I don't think there's like one single thing that management would do that made me go but there are some. There's one particular trait that I tend to look out for, which is that I want management teams that have a different way of looking at the world, right? And a different way of looking at the world, I think one really good example that I can think of offhand is Haidilao, which is this hot pot company that originated from China and is now its business is predominantly in China, but it's now in many other countries in the world. So Haidilao is unique because it pays its employees really well and treats its employees very differently. So for example, right, if you're an employee in Haidilao, if you hit a certain level, say if you're a restaurant manager or above, if you leave the company, right, Haidilao would pay you quite a significant sum of money, no questions asked, right? And this is something that not many restaurant companies would do. And if you work in Haidilao as in one of its restaurants, even the most low-level employees would have the power to either give customers discounts, free food, or a completely free meal. And that is also very much unheard of in the restaurant business. But you know what's interesting? Like all of these actions that Haidilao does, right, they are not secrets. In fact, like I think if you are in the restaurant business, most restaurant entrepreneurs would probably know what Haidilao is doing, right? And in fact, there was a book published in 2011, I think, called Haidilao 你学不会, which is translated into You Can't Copy Haidilao. So in the book, it kind of detailed all of these unique things that Haidilao was doing in terms of managing its employees, right? And so they are not open secrets, but yet no one is doing it. And Haidilao has been so successful as a restaurant company doing it.
Yeah.
So when I find a management team that has a unique way of looking at the world, I get very excited because it is something that I think can potentially be unreplicable because this unique worldview comes directly from the entrepreneur or the CEO's mind. And it's not something that can be replicated because if I were to want to replicate what Haidilao is doing, I will need to fully believe in it. And can I actually do so? That is a big open question. Yeah, and so I tend to look out for management teams that have a kind of a different way of looking at the world.
Very good. Actually, what he mentioned about Haidilao's example reminds me a lot of what Tom Peters actually said. Tom Peters, he in his Monish Prabha actually mentioned this about the example of the gas station. 2 gas stations, and then the other owner of the gas station saw what the other owner is doing, which was like giving free window service or whatever, but the other owner just doesn't want to copy it. And yet the other gas station is thriving. And this is exactly a business principle that, like what you espouse, not many people would do it because they think it's either, why should I copy him? Secondly is, do they actually believe in it?
Yes. Yeah. Yes, that's a fantastic example. It's first time I'm hearing it, by the way, but so good.
Yeah, it's actually true because I think that there's a lot of ego involved.
I think the key is ego because it's not original. It must come from original. Me.
Yeah, but I think like Walmart copied Kmart.
Yeah,
and then so many like I know like Excel doesn't even belong to Microsoft.
Yeah,
right. They copied from someone else as well.
Yeah.
So okay, now before I move on to one of the more interesting articles that you've written, which is about how your fund has done. One thing I want to ask you about, very interesting, and this is like a huge debate among investors, right? Which is, you mentioned earlier about diversification. And so you mentioned you have 47. We know like when we spoke to Eugene, he has like 80. It's like, wow, okay, it's like ETF really. And the thing is, we... based on our experience, we talked to a lot of people and they seem to say the opposite, right? They say that, no, why put like money into your 13th best idea when you can put it into your 5th and things like that. So I want to get your thoughts on where you stand on this. I know where you stand on this spectrum, but why do you edge towards, being more diversified in your strategy?
Yeah, so I think there is no right number when it comes to diversification, right? And I say this because, so if you look at 3 really good investors, so the first one would be like, say, Charlie Munger, Walter Schloss, and Peter Lynch. So Charlie Munger is famously known for having heavy concentration, right?
Very heavy.
Even when he was running a hedge fund, I believe he only had like a handful of stocks in his portfolio when he was an actual hedge fund manager. Then if you look at somebody like Walter Schloss, who very interestingly is a contemporary of Buffett and Munger.
Yes.
I think they were all friends and close friends at that. And Walter Schloss at any point in time would hold maybe 100 to 200 companies in his portfolio.
Correct.
Right? And then when we look at Peter Lynch, when he retired, near his retirement from Magellan Fund, he had 1,400 companies in his portfolio.
Correct.
Right? And so when you look at these examples, and all of them have phenomenal long-term track records, all of them looked at stocks as a piece of a business, but they have such different views when it comes to diversification. So what I think is that there is no right answer when it comes to it. It's more about what number is the investor comfortable with, right? So in my case, when I was managing money for my family's portfolio since October 2010, it was nearly always a very diversified portfolio, and it was something that allowed me to sleep well at night.
I see.
Right, and so I think that is the kind of like the right number for me when it comes to having peace of mind when investing. And I think peace of mind is super important because I do not want to be in a position where I would be overly stressed about managing the portfolio, and because I think that would result ultimately in subpar investing decisions. Right, I need to have I need to have mental clarity to be able to make good decisions, and I do not want to. I want to minimize the chance that fear would come and mess around with my thoughts.
Understand. So if you're talking about 40 or close to 50, let's run it out to 50. You're talking about an average to about 2% per position. Is that correct? Is that the math that you work with?
Yeah, kind of. So again, so I think there's a this is kind of a question related to like portfolio construction, right? So my personal point of view is that I view portfolio construction as something to be kept as simple as possible. So a friend of mine and an ex-colleague of mine, his name is Chin. He used to say that he thinks that portfolio construction is like cooking seafood. When you cook seafood, when you have really good ingredients, you want to use the simplest cooking methods. So when you have like really, really good fish, you want to just steam it, right? You do not want to add curry, you do not want to add ginger and so on. You just want to like steam it so you can enjoy this really fresh fish.
The natural taste,
and I kind of connect very much with this analogy. So I also see portfolio construction as very much like cooking seafood, and where if you have really good ingredients, and ingredients will actually be the individual stocks, right? Then I think the cooking techniques you use would you only require really simple cooking techniques. Right. So in my case, it's kind of like then it means that in terms of the portfolio construction, I can I can get by with very simple kind of portfolio allocations. I don't need to overcomplicate things.
Understand.
So I assume you're not a fan of no more than 2 stocks in the same industry or 20% of your portfolio in the same sector.
Correlation.
I wouldn't say I'm not a fan. I think that this works really well for different investors.
Okay.
What I would say that it is not the right way to invest for me.
Okay. Okay.
I just want to dive one more question deeper on the portfolio. I know you it's a very good point that you mentioned. It has to be simple and all that, right? Does it lower your barriers to entry because of a lower portfolio size? So what I mean by this is a lot of investors, right? If they find a technique of discovering good pieces of businesses they want to buy, but then because they do not set their barriers of entry high enough, like those guys who are focused investing, then they tend to pick like a lot of companies. Like, I want a bit of this, I want a bit of this. Do you find that because you are setting that portfolio construction more simpler, it actually helps lower your barriers of entry, or am I getting this wrong? In your opinion?
No, I think that's a really interesting question. It's not something that I've actually thought about from that angle, actually. But what I don't think it leads me to lower my barriers of entry, because I tend to have a pretty high barrier to entry when it comes to the types of companies that I want.
Great.
So maybe we can talk about that in depth later if you want to.
Yeah.
But very quickly, I tend to look for companies that excel, that tend to do well according to 6 traits. So first thing is that they must be operating in large and or growing markets.
Okay.
Right. Second thing is that they must have balance sheets that are strong, so typically more cash than debt.
Okay.
The third thing is probably the hardest, which is that I want management teams with equal measures of integrity, capability, and the ability to innovate. The fourth thing I want high levels of recurring revenues, either from contracts or customer behavior.
Okay.
The fifth thing I want is that I want companies with a proven track record of growth.
Okay.
And the last thing I want business models that give me confidence that this company can produce high levels of free cash flow in the future.
Okay.
So I don't think it's that easy for companies to excel according to these criteria.
Yeah.
Right. And so I don't think it kind of lowers the bar for me, but perhaps it could lower the rate of return for my overall portfolio. Why do I say so? So for example, let's say if I invest in 50 companies, I cannot expect all 50 of them to generate, say, a 30% compound annual rate of return in their business over the long period of time, right? But perhaps some of these guys will do 15%, some of these guys will do 40%, right? And if I average them out, I can still end up with a very healthy long-term return. And if I end up with, say, a 20% annualized rate of return versus 30% annualized rate of return, would that be a disaster? I don't think so.
Nope, definitely not.
I guess what I'm trying to say is that I'm trying to optimize for peace of mind rather than trying to optimize for returns.
Right.
Yeah. Because because one of the proponents of focus portfolios like Munger, right? He can go on reading Barron's for tens of years and he can't find a single stock. Whereas that's a struggle that we meet with even our coaching clients and our e-learning clients, right? Is that so difficult to do research. How much do I need to read in order for me to make a decision? And that's why I'm asking that question.
And do you think, right, based on what you're saying, that you have these very clear criteria that actually speeds things up for you? Like you maybe you read a prospectus, or I don't know what they call it in
Singapore?
No, in the US there's but I know 10K, 10Qs.
S1, yes. The S1 filing.
Yeah, correct. So that means because you have these criteria in mind, then you kind of know how to zoom in. Am I right to say that?
Yes, it helps to speed up the research process very quickly. So like when I come across companies, I tend to I prioritize companies that do well according to the criteria that I've set. Right. So it does not mean that I completely ignore all the companies that don't do well according to my criteria. So sometimes there may be interesting opportunities, right? It's like, so for example, I'm not averse to investing in special situations or companies with hidden asset values and so on.
Right.
But when it comes to the time that I use for research, I prioritize the companies that do well according to my criteria. So from that perspective, yes, it helps to speed up, I think, the research process. So it's kind of very quickly, okay, I know that this is a company that could potentially be a long-term compounder. And so I'm interested to dig in further.
Okay,
right.
Great.
So speaking of key lessons, I think so for those listening, Ser Jing actually has a blog called the goodinvestors.sg. And one of the one of the most interesting article is the fact that you were actually investing money for your family for 10 years and you actually compounded, at an annual return of 19%, as you said earlier on. So I believe I made a mistake. I said 7 years. Actually, it's 10 years earlier on. And you constructed 17 investing lessons. Now, for those of you who don't know what 19% is, right, over these 10 years, it means that for every dollar you invest in Ser Jing's fund, right, you will have grown to $5.50.
Yeah.
Right?
Almost a 5x. Yeah.
So it's
more than a
5x. Yeah, it's a 5.5x, right?
Yeah.
And I think, I don't know whose pension fund is growing that fast. Just, But yeah, what are these 17 investing lessons that you learn, right?
What are these 17 investing lessons? So I think it's found in the blog post that I have. Let me just pull it up real quick.
Yeah, probably the top three.
Yeah, like the
Just
top
the
ones.
top three. I think the rest they can read, but more importantly, what are you feel were the top three that that you carry on until the running the compounder fund?
Yeah, top three.
Yeah.
Give me a sec.
Yeah, sure.
Okay, so I think the top three would be. Oh, actually, they turn out to be the first three lessons that are in the article also, right?
Yeah.
So I think the biggest lesson that I have is that we should be really focusing on business fundamentals. So when I tell people that I'm investing in the stock market, right, inevitably I get asked, after maybe a few minutes of conversation, inevitably I'll get asked like, what do I think about the latest?
Tell me about it.
Insert the latest disaster, right, or the latest uncertainty or whatever.
Yeah.
And I often have to spend time to explain to them that, hey, I know that these things are happening, but they are not things that I'm focused on. I'm really focused on investing, or in fact, I'm focused on finding really good businesses, right? And I'm focused on business results. I'm focused on business developments. And throughout the past 10 years that I was managing my family's portfolio, so that would be from October 2010 to June 2020. So it's actually a 9.5 year period, so nearly 10 years.
Yeah.
During that period, like I did not spend a single minute thinking or worrying about geopolitical or macroeconomic developments. All I was concerned about was, I have money coming in now during this quarter. What is the best company that I can find to invest in during the quarter, right? And so I was just very laser focused on business developments. And I think that this is also not a unique insight. It is something that Warren Buffett has been telling investors for decades.
Yes.
Right. If you read his Berkshire Hathaway shareholder letters, he has been saying this over and over and over again. And but I think it's still a lesson that people need reminding of from time to time.
Yes.
Yeah, so I think it's one of the most important lessons that I have. And the other one would be to adding to winners. Right. And I think this is also very counterintuitive. People often talk about averaging down, right?
Yes.
When the stock price has gone up, people tend to not be interested to invest in it. But my take is that, if you have and by the way, adding to winners is not something unique that I developed myself as well. It's something that I first came across from David Gardner, one of the Motley Fool's co-founders.
Yes.
Right. And so the way I see it, why adding to winners work is that, over a long period of time, if a stock is doing well, it is very likely because its business is doing well. And what are the types of companies that I would want to invest in? I would want to invest in businesses that are doing well, right? So then, by default, these would be the ones whose stock prices have already increased over time.
After a cycle, right?
Yes.
Right, yeah. So I like to add to my winners as well. And it has also worked out very well for me, for my family's portfolio. So that's another key takeaway that I have. And the last one is that, the next Amazon is Amazon. And so that's the lesson number 3 in the article. And
this is good.
And I say that, because, so oftentimes people are so, caught up about finding the next Amazon, right? And they look at, Amazon has done so well since its IPO. I need to be able to find the next one that can go on to compound. But from Amazon's IPO to date, I don't have the exact figure, but I assume that it's probably compounded its share price by 40% or something.
Yeah.
Since its listing, right? Probably thereabouts. And very interestingly, if you look back at the rate that Amazon had compounded over the past, say, 5 or 10 years, the rate of return is actually very similar to what Amazon had done from its IPO, right? And so what it means is that, the next Amazon could very well be Amazon, right? And by the way, for full disclosure purposes, I own Amazon in the investment fund that I'm running right now. Yeah. So I think people often, kind of ignore proven winners or companies that have already done well simply because they've already risen by a large amount over time, and they ignore it and want to find the next shiny new thing. But I think that oftentimes the next shiny new thing is actually the old shiny new thing, especially if their businesses still have tremendous runway for growth. Now, I mean, of course, there are companies where say in the first 20 or 30 years of their lifespan as a public company, they may have compounded their revenues or cash flows at 20 or 30%, and because they have kind of run out of room to grow, their rate of compounding in terms of their revenues and cash flows have declined to, like the low single digits.
Yeah.
In that case, then, the next Amazon isn't the next Amazon. But then there are also special cases where even after compounding their business at 30% for the past 20 or 30 years, they are still able to do so over the next 20 or 30 years.
Correct.
Right? And if that's the case, then the next Amazon is Amazon.
Yeah. Great.
Sorry to interrupt this podcast. I know it's a little bit annoying, but I want to tell you something that I think can be really helpful to you. I can tell you're really interested in the stock market and want to learn more about it so that you actually know what you're doing, especially when today things are getting more complex and complicated. That's why we came up with the Stock Investing Blueprint, or SIB. It's our signature e-learning program that teaches you how to pick the right stocks most of the time, buy and sell it at the best possible time, and manage your stock portfolio systematically. It currently has more than 10 hours of content, and it's growing. You'll also be part of a group of like-minded investors that can help speed up your learning process. To hop on the program, click on the link in the description or go to learn.firl.co/courses/SIB. This is a good segue into, I think, the juicy segment into this podcast, right? So you say that one of the big lessons is that next Amazon might be the next Amazon. So let's talk about the stock that you've had the best percentage gain on, which is Netflix. Is Netflix the next Netflix?
Yeah, I mean, so I own Netflix in the investment fund that I'm running. So yes, I do think that the next Netflix is Netflix. So is there any particular angle that you guys want to start the discussion?
What is the case for Netflix? Why people should not necessarily buy, but why should people look at Netflix?
Sure. So I think the first thing is that I think Netflix has one of the best management teams in the world and this and it very much has to do with Reed Hastings.
Right.
So when Netflix got started, they named themselves Netflix, not because and they named themselves Netflix for a reason, right? They did not name themselves DVD by mail or some other name.
Yeah.
And the reason is because they already had the idea that the real holy grail when it comes to entertainment would be the deliverance of entertainment via the internet. And so they named themselves Netflix. And so from very early on, they already kind of knew that this was where the world was heading towards, right? And so I think that's one really interesting thing that I kind of discovered about Netflix management team. The second thing is that I thought that what they did in 2011 was super interesting. So what happened in 2011? 2011 was the year where Netflix share price, I think, fell by about 80% or so from top to bottom.
Okay.
And it happened because Netflix wanted to completely spin off its legacy DVD by mail business. So for people who do not realize, in Netflix early days, it actually had like an online portal where people could sign up and choose the DVDs that they wanted, and then Netflix will mail these DVDs to the customers, and then the customers could actually return the DVDs to Netflix by mail.
Yeah.
So the main business was actually sending out DVDs by mail, even though the subscriptions and the choosing the DVDs, all of these things were done via the internet. So it was a DVD by mail business, right? And so Netflix wanted to spin that off into its own company called Quickster, right? And if you Google like Quickster debacle or something, probably can find articles that talked about that episode in Netflix history. So that was 2011. But what I thought was super interesting was because at that point in time, Netflix started its streaming service in about 2007. So streaming was about 4 years old and barely monetizing.
Yeah.
right? But management was like, you know what, let's just spin off Quickster, and then we'll focus all our attention on the new business, which is streaming. And I thought that was really amazing, because how often do you find a management team that's willing to cannibalize, or rather that's willing to completely kill off its cash cow, its legacy cash cow, to focus on what it thinks is the future.
Yeah.
Right. And so to me, I thought that was a very strong sign that Netflix would be incredibly hard to disrupt. Right. And then the third interesting thing that I kind of identify with Netflix management is also kind of related to the disruption, which is that, if I were to ask both of you, what is Netflix, when I say competition for Netflix, what do you think about first?
HBO, Disney Plus, all these kind of guys.
Yeah, right. So very naturally, you will think about other streaming services providers, right? But years ago, Reed Hastings already came out to say that, these guys, yes, they are competitors of Netflix, but from his point of view, the real competition is actually any activity that you spend time on other than watching Netflix. So that includes exercise, that includes time out with your friends, that includes reading books and so on. So it's a very unique kind of way of looking at the world. So remember earlier on I talked about unique way of looking at the world, right? So this is another example.
I see.
These are some of the things that I saw Netflix management doing that I think is just so interesting, right? And so what has happened because of like the forward thinking the Netflix management has is that Netflix today has like the single largest pool of global subscribers in the world, and it's actually a very powerful weapon for two reasons. First is that it enables Netflix to curate data that no one else has, right? The more subscribers it has, the more data that Netflix can collect about what works and what doesn't when it comes to the production of original content, or when it comes to acquiring content from third-party producers, right? So what it also means is that Netflix use of capital can become more efficient over time. Second thing is that Netflix can actually outspend its competitors, but at the same time keep its cost per subscriber to a very low level, because it has such a huge subscriber base, right? It can afford to spend more, but at the same time keep the cost very manageable from a per subscriber point of view. So I think this creates a kind of flywheel where the more subscribers that Netflix has, the better the service can become for existing subscribers and new subscribers. Right.
I see.
And I think that over time, as Netflix goes more and more into original content production, what it also means is that the Netflix service becomes more and more attractive for new subscribers.
Understand.
And this is actually something that is quite unique, I think, among businesses, because most of the time when you have old products, people tend not to. For most companies, they often need to refresh their product suite, right? You cannot keep selling your old products. But in the case of entertainment content, sometimes if it's really good content, the useful lifespan is super long, right? If you look at and if you look at, say, some of the old sitcoms in the US, like Seinfeld, Friends, people are still watching these programs, and these were programs that were created 20, 30 years ago, right? And they're still so popular. And so what it means is that I think over time, the Netflix content suite, I think, will become more and more valuable for new subscribers. And so it's a very interesting dynamic in the business that I think is quite rare among companies. And I think for a long period of time, people were also kind of confused about Netflix cash burn, right? So for a long period of time, Netflix was burning cash, and I thought that it had a good reason for doing so.
Yes,
and it's because it was actually producing cash upfront to produce original content.
Correct.
So it's basically has to burn cash. But if this content actually has a lot of economic value, right, then it actually makes sense to spend the cash upfront to create the content so that it can win subscribers that have like a long lifetime value.
So
right?
Marvel's
So
on steroids in a way.
Yeah, exactly. Yeah. So we have come to a point in time now where Netflix can self-sustain its business from a cash flow perspective. So when it was burning cash, it actually had to tap into the debt markets. It had to borrow money to fund the creation of content. But now it's at a point in time where when Netflix believes that it will no longer be necessary to tap into the capital markets, so it can actually self-fund from the cash flows from its business. So again, it becomes so I think the risk of investing in Netflix has also been lowered substantially as compared to, say, just 1 or 2 years ago.
Understand. Yeah. Can I be a devil's advocate?
Sure, go ahead.
Yeah.
Of course, at any point in time, feel free to challenge.
Yeah. By the way, I'm a huge fan of Netflix. When it first came to Malaysia, the only reason why I couldn't subscribe was I felt that the content repository at that point of time wasn't as much. We're talking about 6-7 years ago. But today is like, my God, every original content that they have produced, I'm like a huge fan because I'm a huge documentary fan. And I think there's one episode about the Earth, how it works, and I see the behind the scenes. Oh my goodness, it's amazing. Okay, here's my devil advocate's point. One, you already mentioned that the other streaming services are actually not their competitors. Guys like Disney Plus, guys like Hulu, all this, all right, this streaming. But then how would you address the total addressable market for Netflix? Where is it eating into an existing pool of customers, meaning those guys who are on cable? I mean, in Southeast Asia, there's not many people who are on cable, actually. Most of the guys actually run quote-unquote pirated kind of content, right? And secondly is, at which point, because creative process, I mean, I'm a huge fan of Robert Iger, and I finished when he was describing how he bought Marvel, Pixar, and all this, right? He actually described that the creative process is actually very difficult to qualify and to repeat, because you can actually throw tons of money to create content, and you can do tons of studies to say whether this content is good or not, but you do not know whether the content sticks. I don't know whether you follow me, right? And
I do.
Yeah, so I mean, while I'm a fan of a lot of the original content that Netflix does, it's also a game of chance, because you do not know whether the original content and the amount of money you spend to create this creative material actually sticks. So what is your counter to probably, one, the first thing about total addressable market, and two, the strategy of creating original content and getting it to stick?
Yep. So on the topic about total addressable market, right? So when talking about that, you brought up you mentioned that other cable services or rather other streaming services providers are not Netflix competition. I would actually I actually say that they are Netflix competition, but they are not the only competitors that Netflix
okay,
has.
great. Thanks.
Right. So that was the point I was trying. Yeah. No worries. And okay, so about the total addressable market. So with Netflix, I think it's a really good example of a company that, in my opinion, has created a tailwind. So when we often talk about companies, we like to use or rather like I come across phrases like companies are riding on the tailwinds of like e-commerce and all the other kinds of growth industries. But I think there are special companies that are the ones that are creating these tailwinds. And in my opinion, Netflix is the one that's creating this tailwind.
I see.
And when you have a company that creates a tailwind, right, I think what's unique is that it's often very counterintuitive to think about the total addressable market. Not counterintuitive, but rather I think can be difficult.
Yeah.
And difficult in the sense that it can often be larger than what we expect.
That's the reason why I'm asking, actually, because it's very difficult.
Correct. Yeah. So the idea is that because Netflix is creating this completely new market that previously had not existed, we tend to look at cable spending or whatnot as kind of like it's kind of like a proxy for the market opportunity Netflix has, right? But actually, I wouldn't be surprised, right, if Netflix actually in its most mature state, it will actually end up with significantly more subscribers as compared to cable. And the reason is because the service is currently offered at a relatively low price point compared to cable, right? And so what it does is actually, I believe, it opens up the market opportunity for so what it means is that there will be a lot more people that will be willing to subscribe to Netflix versus subscribing to cable. Right. And I think that could potentially create a larger market than cable previously. And so I think this is like the thought process I have when it comes to Netflix market opportunity. But even then, if you just look at like what we currently like if you just look at the hard numbers, there are I off the top of my head, I can't remember how many broadband subscribers there are in the world. But if you have an internet connection, then you are potentially fair game for Netflix, right? You could potentially end up being a subscriber to Netflix, and even within the same household, we may also end up having people that have multiple Netflix subscriptions.
Yes,
right. Because people may want to watch different programs at different points in time, right? And so that's why Netflix also has this idea of creating like multiple logins per account, at a higher price point. So in a way, these also can be seen as different subscriptions within the same household, right?
Agree.
Yeah, so these are again, I think, ways where Netflix can potentially expand the overall pie from what we kind of currently perceive it as. So I think most people kind of perhaps think about Netflix market opportunity as like what people have been spending on cable historically, but I think it goes beyond that. Yeah,
Great.
simply because Netflix has created a new market that previously did not exist.
If the CEO says that the competitor is like everything else, right? If you want to throw in gym membership also can. Why not? Just throw it in, right?
Yeah,
Because what
the
people
reason
spend on
why
gym.
I asked Ser Jing was because of this, MJ. I've listened to a lot of case studies being presented about Netflix. They even did a comparison of total broadband usage, total cable usage in America, and then try to compare it against different benchmarks. And I just wanted to get his thoughts. But more importantly, also about the direction in which the original content production money is going to and how is that capturing. Because I think Fortune magazine gave a cover story about Netflix growth in subscription comparatively to Disney Plus because of cricket in India. Of all places, because Netflix is not known to be strong in sports,
Yep.
whereas Disney has an advantage because they own ESPN.
Yeah.
So
Yep.
what are your thoughts in terms of original content production and money well spent there actually?
Yeah, so I think if you look at the subscriber growth that Netflix has had over the past few years, especially, so I think Netflix kind of really started ramping up content spending probably around 2013 or 2014. So as in kind of started ramping up original content spending sometime in 2013 or 2014. And if you look at the subscriber growth that Netflix has enjoyed since then, I think that is proof enough, as in that's solid proof that, it has been money well spent. Now, you mentioned earlier that, creating original content is a hit and miss process.
Yes.
And I completely agree. In fact, I think no one should ever expect Netflix to have a 100% hit rate, right? I think it's just impossible. But at the same time, I think that there are companies that somehow have a special ability to create really good stories and really good content.
Yeah.
Disney is a fantastic example. I mean, if you look at what the Marvel Cinematic Universe
Yeah,
has
crazy.
done, I think it's phenomenal, right?
Yeah.
And I don't think anybody would claim that Disney is lousy at creating good original content, right?
Yes.
So they have some of that special sauce. Now, with Netflix, perhaps it's a little bit more difficult to ascertain that because I think I don't have hard data to back me up, but my sense is that Netflix perhaps relies on data a lot more than Disney. But one thing that I find interesting is that in terms of securing Netflix's ability to continue producing good content over time, is that Ted Sarandos was recently promoted to co-CEO of Netflix.
Okay.
Right. And so Sarandos for many years was the head of content production. So even as co-CEO now of Netflix, he will still be focusing on content production at Netflix.
Okay.
So this is again I think a really good move by Reed Hastings, right?
Okay.
So he kind of identified one of the key leaders in Netflix and make sure that gave him a career progression and gave him a position where I guess he would be a lot happier to stay on as compared to just being head of content production. So Reed Hastings made Ted Sarandos co-CEO of Netflix.
Okay.
Right. And I think that also helps to perhaps safeguard Netflix's ability to continue producing good content over time.
I see. Okay, great. Wow,
So-
we've beaten Netflix to death, really.
Yeah. So before we move on, let us beat it one last time.
Okay, please.
Before we move on to the next talk, what will cause you to not hold on to Netflix?
Yeah. What will be your sell indicator?
My sell indicator would be if I realize that subscriber growth has kind of completely created.
Okay.
Right, that would mean that Netflix will actually be approaching saturation a lot earlier than I expect. Yeah. Or if I see the management team kind of lose focus about the business. So I think one of the key strengths about Netflix is that it is uniquely focused on streaming, right? And if I see that Netflix is, so I think when you're uniquely focused on streaming, there's also potential for optionality in the sense that where if you generate really good original content, there are other ways of monetizing the content, right? I mean, like this again, Disney is a great example of that.
Oh, yes.
If it has a really good movie, it can put that movie into the theme park, it can create toys, it can create TV series and so on.
Tell me about it when you have parents and kids that, do you want to build a snowman?
That's it.
That's
Frozen, yeah.
That's it. The
Yeah.
wallet.
So I think so I think this is so there's some kind of optionality there. I think so. I don't mind if Netflix pursues that kind of growth, but I think if management kind of loses focus on the streaming service itself, then I think that will also cause me to that would be a yellow or even a red flag for me.
Right. I see. Great.
Okay, moving on to the next stock. We talked about this stock a little bit earlier on, which is Haidilao. Now, the reason I picked this stock out is because I know that a lot of our listeners, I would say 75% already tried it.
Yeah.
And I'm quite sure they quite enjoy it. I kind of enjoyed it. I think, John, you think it's slightly overrated for the price. But you mentioned earlier on, for Haidilao, the culture is very unique. And you've explained quite clearly what that uniqueness is. So now I want to ask a little bit broader. Beyond the culture, right? What first caught your eye about Haidilao? And as well as, are you invested in it? And if you are, why are you holding on to it? Like, what's interesting about the stock?
Sure. So I own Haidilao in the fund. And so actually there are really two things that kind of caught my eye with Haidilao. So the first is I think it's a track record of execution. So when you look at the growth of the company, it has been phenomenal. So I think revenue has compounded over the past few years at about 50% or so, right? If you exclude 2020, and even in 2020, I think Haidilao grew top line at maybe about 20% or something.
It's still amazing, man.
Still amazing, yeah. And the second thing is really its culture. So I think Haidilao is a hot pot company, right?
Yeah.
Like there's nothing special about hot pot. So what really sets Haidilao apart would really be its culture, right? And so I was really attracted to Haidilao for its culture. Yeah, so these are the two things that kind of really stood out for me when I was looking at the company. So why am I still interested in the business, right? So I kind of talked about the unique way that Haidilao manages its employees previously. So maybe I can talk a little bit about like the market opportunity, right?
Yeah.
So like if we look at in China alone, so Haidilao today is in many other countries, right? But China accounts for about 90% or so of its revenue.
Okay.
So it's still very much a China-centric story. So if you look at China, right, the entire restaurant market in China in 2017, right, was about 4 trillion renminbi. 4 trillion. So huge number, right? And Haidilao. So and if you break that down again, right? So in the restaurant market in China, we can break that down into Chinese cuisine. So Chinese cuisine, right, is, in 2017 was about 80% of the total restaurant market. So it's about $3.2 trillion.
Okay.
Right, and then within the Chinese market, right, we can break it down into different styles.
Yeah.
So hot pot restaurants, which is where Haidilao is in, had about a 14% share of the total Chinese cuisine restaurant market in 2017. Right. So if we look at the hot pot restaurant market in 2017 is worth about slightly over 400 billion renminbi, right? And so just this 2017 number, which I think today is probably larger given China's GDP growth and GDP per capita increase and so on, it's still easily more than 10 times Haidilao's current revenue. And we're only talking about a very narrow definition of Haidilao's market opportunity, right? Yeah, and then when we look at the number of restaurants Haidilao has today, right, it only has like a few hundred restaurants, right? Now it's probably closer to, I think about 900 or so.
Oh, close to 1,000
right.
already, yeah. Wow.
Yeah, close to 1,000, correct. Yeah, but even then, right, it's still very much very, very small. I mean, if you look at, say, the number of McDonald's there are in, say, just the USA, right?
Yeah.
There's like I don't know, 12,000 or 14,000 or something McDonald's in the USA. I mean, of course, Haidilao is much larger than, I mean, in terms of a single restaurant footprint. Haidilao is much larger than a McDonald's. But I think that also gives you a sense of like the kind of opportunity I think that Haidilao has to grow in just China alone, without talking about other countries around the world. So when I look at the market opportunity and when I look at what's special about Haidilao, I think it's very interesting for me. So I actually, about the culture, right? Maybe I want to bring out some interesting point that I have. So I think one of the in recent years, one of the changes to my investment thinking was actually inspired by this business writer named Ben Thompson, who writes this newsletter named Stratechery. I hope I'm pronouncing it correctly.
Stratechery, yeah.
So in one of his articles for the newsletter, Thompson actually wrote about this idea that, if you have a company whose product is trying to exceed user, is trying to achieve what they call the perfect user experience, right? It's actually unattainable. So when people think about the perfect user experience, right? People generally think about it as like a straight line, right?
Yes.
Like horizontal line. Then you try to create a product that tries to meet that horizontal line, right? But in actual fact, humans, we are, in Jeff Bezos' words, right, divinely discontent. Meaning that what is magical yesterday, right, becomes table stakes today. So think about like e-commerce, right? Like today, you know, if somebody says that I can deliver goods to you in 1 month's time, you'll be like, oh my goodness, 1 month, that's so long. Because we're so used to delivery that comes in like 1
Amazon
week
Prime,
or 2
right?
days or something, right?
Yeah.
But I guess maybe, I would bet that, you know, maybe 5 years from now, we would think that 1 day delivery is too long. We want 2-hour delivery. Right? So I think it's a fantastic example of how humans are divinely discontent. So what happens is, when it comes to meeting the perfect user experience, right, the graph, instead of having a horizontal line as the perfect user experience, the line is actually tilted. Meaning that it is nearly impossible for companies to meet what is called that perfect user experience, because this perfect user experience keeps rising over time.
It's a shifting goalpost,
Correct, it's a shifting goalpost. And I think so what is unique about Haidilao is that I believe, me and my partner Jeremy, we believe that Haidilao is a very unique company in that it will always be one of the first few restaurant companies to think about new ways to delight customers. In other words, it will be one of the first few, or in fact the first restaurant company to come up with a novel way of creating a better user experience, simply because of the way Haidilao is being managed, right? And so what it means is that, like, I think that if Haidilao is always competing on the user experience front, then it will nearly always be at the forefront of competitors, right? And so I think that's what's special about Haidilao for me. And maybe I can also talk a little bit about like what is unique about the way Haidilao manages its restaurants, right? So, you know, most when you talk to most restaurant owners, they probably look at a restaurant's P&L as one of the key performance indicators, right?
Correct.
But for Haidilao, no, they don't look at the P&L. What do they look at? They look at 3 things. The first is they look at the attitude of the employees in the restaurant. They want when the higher ups in the company walk into a Haidilao restaurant, they want to see employees who are driven, who are motivated, who are serving customers well, right? Second thing, they want restaurant managers who can actually groom talent. They want restaurant managers who can groom future restaurant managers. So they actually, one of the key performance indicators, right, is that they actually look at the quality of the people under the restaurant manager. They want to see that as a restaurant manager, you are actually grooming talent for tomorrow.
We'll talk about succession planning on steroids, man.
Yeah. And then the third thing they look out for, right, is that they look at customer satisfaction, right? And so these are, I think, very interesting from a restaurant perspective, right? But it kind of, in a way, also all ties back to this idea of the user experience, if you think about it, right? You know, like if you have really good employees who are driven to serve customers well, and if you have very high levels of customer satisfaction, that again boils down back to the idea that, you know, you keep wanting to innovate and keep wanting to improve upon that very important metric of the user experience, right? So so when I look at all of these, I find Haidilao to be a very interesting restaurant company. In fact, I think it is the most interesting and most unique restaurant company that I've come across.
So why sorry,
go ahead.
So how do they measure things like that? That would be my question. How do they measure those 3 KPIs?
Because it's very qualitative.
That's right. How do they?
So the other interesting thing about Haidilao is that, you know, if you want to be like if you want to be at a level of restaurant manager or above, you need to start from the bottom. So most of the higher ups in HQ, right, actually started from the bottom. They start off as cleaners or waiters and so on, or cashiers, and they work their way up. So these people often have like this qualitative eye when it comes to gauging these qualitative things that you talk about. So this is again something that is very unique about Haidilao. The fact that most of the high level executives in the company actually start from the lowest level. So like Chang Yong, who's the founder of Haidilao, the whole story of Haidilao is that Chang Yong actually started off with just by creating his own hot pot restaurant, and he was doing everything within a restaurant. So he knows intimately all the different types of difficulties that are involved with running a restaurant, and like also how to gauge employee and customer happiness and so on.
So you don't need an MBA lah, just checking to be high up.
I guess so.
I think it was a pun. Yeah, actually it's related to the question that MJ actually asked, because Great that you brought out this distinction that most restaurants, they go in and they want to see a P&L, and then Haidilao is approaching from a qualitative perspective. But just curious, I don't know whether Haidilao has done it or you have done it yourself. Do you see the correlation in between the three qualities that Haidilao measures up their business performance against that of revenue in some kind of quantitative measure? Have you know, because it's so qualitative, the measurements, and then but at the same time you're running a business, you have shareholders. How has anyone done that correlation before, in a sense?
So if you look at Haidilau's historical business growth, right? Like I mentioned, you know, revenue over the past few years has compounded at about 50%.
Yeah.
And the bottom line has also compounded at a pretty similar rate.
Okay.
And the profit margin for Haidilao is pretty healthy as well. It's in the high single-digit percentage range.
Yeah.
So, you know, when you look at the business results that Haidilao has delivered, I think it's very hard to say. I think it's very difficult to come to any other conclusion other than, like, you know, these qualitative measures have succeeded.
Okay.
So how about and I think this is the last point I want to make on Haidilao, making me hungry a bit. You know, how about the valuations? I think that's something anyone looking at Haidilao would really want to know. I think on Google is saying it as 620 times earnings. Not necessarily a bad or good thing. I mean, Netflix has been there before, or quote unquote worse.
Yeah.
How would you justify this sort of valuation? Is that, like, for example, I was reading this book by Chris Meyer, the 100 Bagger book, and he said that for Amazon, it was justifiable for them to be either losing money or making very little, because
loss leaders.
You take out the R&D, they were trading at 10 times earnings, right?
Yeah.
So in the case of Haidilao, right, I'm sure the reason their earnings now are not doing well is because not doing like optically and accounting wise well is because of a lot of investments. But do you think that it is justified what's happening right now?
Yeah, so the PE ratio that Haidilao currently has, right, like you mentioned, is actually kind of not an accurate reflection of the actual valuation, because Haidilao had actually made significant losses in the first half of 2020 because of COVID. Like
yes.
Yeah, because of COVID, you know, restaurants had to close down, or there were a lot of other social distancing measures that governments around the world have put in place, right? And so because of that, as a restaurant operator, the company also suffered in 2020, and that's one of the reasons why the valuation is so high, right? But I think that even if you kind of apply normalized profit margin to Haidilao's current 2020 revenue, I think its valuation is probably I don't know, around 60 or 70 times earnings.
Okay.
Yeah, probably around the range thereabouts, maybe a bit higher. But is that justified? So I think it really boils down to the ability for Haidilao to continue growing at a high rate over time, right? And so I think that if Haidilao is able to continue growing its revenue at the rate that it has done in the past, then I think that there's a good chance that its shares may turn out to be long-term cheap but short-term expensive.
Okay, makes a lot of sense.
Yeah.
All right, the next one, we went to the US, then we go to China, now we go to South America.
Going to cover the whole globe.
Yeah, Mercadolibre. Now, this one, when I first saw the name, I'm reminded myself of that wrestler, Nacho Libre. I don't know if you know. That's what I thought. So it's like, okay, interesting. But apparently it's quite... I know this is something that you've been talking a lot about in the informal investing group Kairos, and I believe he has done extremely well. Some people are calling it like the Amazon of Latin America. I don't know if that's a good representation, but yeah, what is the case for Mercadolibre? And maybe just share with us exactly what do they do first.
Sure. So Mercadolibre operates only in Latin America. So they are in nearly all of the Latin American countries. The key markets within Latin America that it operates in, I believe, would be Brazil, Mexico, and Argentina.
Okay.
Right. So these are the three most important countries for Mercadolibre. And so you're right that it's an e-commerce company, right? So its main business will be the Mercadolibre marketplace. So it's kind of like a marketplace that connects merchants and consumers, right, to make online purchases. But there's actually more than that. So Mercadolibre also has its own payments services, digital payment services called Mercado Pago. Right. So in a way, it's kind of like the PayPal of Latin America.
The Square or whatever.
correct. So I also own PayPal, I also own Square, and I also own Mercadolibre. And it also has a shipping solution called Mercado Envios. So it's like a logistics solution that helps the merchants. So it provides fulfillment and warehousing services for its merchants. So so I think it's quite. I think it makes sense to say that Mercadolibre is the Amazon of Latin America, but it's more, right? So the Amazon of Latin America and the PayPal of Latin America. And I also own Amazon, by the way. I think the really interesting thing about Mercadolibre is that e-commerce today as a percentage of total retail in Latin America is probably still in the mid to low single-digit percentage range. So I think that alone already kind of gives a good example of like how much room for growth there is for Mercadolibre. And Mercadolibre is currently the most popular e-commerce marketplace in Latin America if you look at like in terms of like the number of visits to its website, right? And if you look back over a long period of time, it has actually been a business that has shown like tremendous amounts of growth. I mean, like if you look at say from 2006 back then, right? If you look at like at 2006, it had like $52 million of net revenue in US dollar terms. And in 2019, if you exclude 2020 because it was COVID, right, and there was this huge surge in growth. In 2019, Mercadolibre's revenue grew to like $2.3 billion. So that's like a near 40x increase in revenue, right? In 13 years. Right, and it managed to do so while keeping the balance sheet very clean throughout that period, meaning that there's very little debt in relation to cash, and also managed to keep the dilution at a minimum. So basically, after Mercadolibre got listed in I think 2007, there has been barely any dilution. Right, share count has grown at a kind of like a very low single-digit percentage range.
Okay,
so. This is a company that I think has just executed very well over time.
Yeah.
And I think management is also one that I rate very highly. So Mercadolibre was founded by this person called Marcos Galperin, who's currently still leading the company as a CEO. And when Mercadolibre was started, right, it started off as just an online payments platform. Not payments platform, online e-commerce platform.
Yeah.
Right. And then when they realized, and when Galperin realized that, hey, people are actually having trouble paying for goods online because in Latin America, unlike say
there's no
in Singapore or
infrastructure,
Malaysia, credit cards are kind of commonly used in Singapore and Malaysia, so we don't think too much about it. But it's not the case in Latin America. Right, and so people need a way to pay for products online.
Yes.
And so they created Mercado Pago. Right, and it has been a smashing success. So today, the off-platform volume for Mercado Pago is higher than the on-platform payment volume, right? So it started off as a payment solution that allowed people to make payments on Mercadolibre's marketplace, but now it has branched out into letting people make payments all over Latin America. Right, you can go to stores and you can make payments via its point of sale solutions as well.
Yeah.
So kind of a very beautiful expansion outside of the core Mercadolibre marketplace.
Yeah.
Right, and then as Mercadolibre grew the marketplace business, they also realized that its merchants have trouble with shipping because, again, infrastructure in Latin America isn't that good when it comes to shipping.
Correct.
So it created Mercado Envios to help out to provide logistics solutions.
Yeah.
Right, and Envios, again, has shown a very, really good track record of growth. And so when I look at a company like this, right, that has been able to expand into new areas of businesses over time very successfully.
Yeah.
I love it, and I think that Mercadolibre is a company that exemplifies this trait that I call optionality. Again, optionality is not it's not something unique that I came up with. It's something that I again first heard from David Gardner, the Mercadolibre co-founder.
Yep.
So he uses optionality as a term to describe the trait that a company has of being able to grow in multiple different ways.
Yeah.
Right, and so I think when I look at Mercadolibre today, it has logistics, it has digital payments, it has e-commerce. It is a company that I think it has just multiple avenues for growth. And I'm very excited about such companies that have like this multiple, there's just so many different ways of growing. And more importantly, these different avenues are all in them by themselves also high growth areas of the Latin America economy.
Yeah, great. I have a related question with regards to e-commerce and ecosystem because I'm not very, very familiar with Alibaba, but what I understood was that in China, it was a similar problem to Latin America. They did not have infrastructure, fulfillment, logistics, and they had to build it from the ground up. And what I'm leading towards too is actually this company in Korea called Coupang, in which they are trying to mimic all this.
Which I believe Ser Jing owns as well.
Yeah.
Yes.
Are we covering that? No. We're not. Okay, so the reason why I'm asking is because one, is the replicability easy? Because I doubt it is, as one. Because I'm trying to find, okay, so let's just say Indonesia is going to start one. And from your experience looking at Mercadolibre, Amazon, like Coupang, right? What do you see are the points that they have or the criteria that they have to create this, the whole ecosystem? Because I believe it's not going to be easy. And secondly, right, do all the ecosystem constituents need to exist before they can succeed? If you follow my question, that means if you just start off with e-commerce, but you do not have the complete solution for payments, you do not have complete solutions for fulfillment, then it will likely to fail. And I want to hear your thoughts on that, actually.
That's super interesting. It's actually not something that I've thought very deeply about.
Yeah.
But I can try to give some quick thoughts.
Yeah.
So I don't think that a company will necessarily fail if the constituents are not there. I think what is more important is whether or not the company has the willpower to want to improve, or rather to build its own infrastructure if there is something that's lacking. So you brought up Coupang, right?
Yeah.
So when Coupang launched e-commerce, it started off again like an eBay where it was a marketplace.
Yes.
But then very quickly, within a few years, it pivoted to become a first-party e-commerce player. First-party meaning that it actually owns the inventory.
Yeah.
So it buys the inventory and sells it to consumers, right?
Yes.
Instead of being a marketplace where it kind of just facilitates transactions.
Yeah.
So when they made that switch in around 2013, at that point in time, South Korea did not have reliable third-party logistics providers that
Correct.
could deliver the types of delivery services that Coupang wanted. And so Coupang created its own.
Correct.
Right. So I think that, and again, when we talk about payments in Latin America, Mercadolibre realized that, hey, it's lacking. And so they created one themselves. So I think it's more about whether or not the company in question, whatever company that is, I think the key question is it willing to invest to build that infrastructure that is lacking?
Understand. Yeah.
Now, if it is, then I think that, chances that it could succeed would be high. Because I think such businesses often tend to have also network effects, right? Where,
Correct.
More merchants lead to more consumers and so on.
Yeah.
So when you get that kind of flywheel started, then it becomes very difficult to break, I think. But on the other hand, we have also seen like Shopee from C Limited, which I also own shares of, do phenomenally well entering Singapore, even after, like, say, when Lazada was already in place.
Correct.
Right. And so I think that is kind of that is very unique, and it's something that I've not actually tried to figure out actively how or why C Limited was able to, or rather Shopee was able to, kind of just break the
monopoly
network effect that Lazada has. But I've not studied too deeply. But one thing I realized from studying the history of Lazada was that it kind of really lost its way, and it wasn't able to kind of localize its services well.
I see.
So Alibaba kind of acquired Lazada and brought in China management, right?
Yes.
And what happened was that, like, they kind of lost out on all the nuances about what makes each local Lazada platform unique for their country, and then that gave like an entry for Shopee to exploit. Yeah. So I think so actually, now that I mentioned this, I think that perhaps what is important is that if you are an incumbent in the e-commerce space, then you really don't want to create openings for your opponents to exploit, right? Like, you want to keep whatever is special, whatever is working, to continue working, and yeah. So I think that was probably the strategic mistake that Lazada made, which was to kind of allow itself to be distracted by it being acquired by Alibaba, and then creating an opening for Shopee to strike. Yeah.
Actually, this for me, when you mention that, right, it reminds me of Alibaba and eBay when eBay was trying to go into China, because Jack Ma actually exploited the nuances of similarly of what Lazada and Shopee had, because a lot of the decision making for eBay China was centralized in the US, and the eBay local team in China had a lot of struggles trying to implement things that will work locally, but they had a lot of bottleneck, put it this way. Maybe I think would it be fair for me to say that Shopee and Lazada in a way quickly took over the market as compared to someone like, what would prevent Amazon from coming here? Let's put it this way. That's the question I'm trying to lead towards. You've got these local incumbents. They have somewhat relied on the other constituents of the infrastructure. So, for example, Shopee has its own Shopee Pay, okay? But in a way, it's not creating an entirely new payment system because Singapore, Malaysia has quite a robust or quite, I would say...
Many options for payments.
Yeah, payments, so it's not there. Logistics-wise, I think Malaysia and Singapore isn't too bad. So what's stopping someone big like Amazon coming here?
Or into South America against Mercadolibre for that matter.
Yeah.
So actually, Amazon for a period of time was in Latin America. I'm not too sure if Amazon still is in Latin America, but they basically have more or less given up.
I see.
Competing in Latin America.
Yeah.
I think at one point in time, in recent times, like Amazon said, you wanted to invest more into Mexico or something.
Okay.
But Mercadolibre is still growing. Yeah, it's still king, and Amazon has actually tried. And so I think I don't think it's as easy as it sounds, for like a e-commerce kingpin to just move into any country that he wants and establish the base. And I think part of the reason is because there's this thing called consumer mindshare, right? Like when you want to purchase a product, you tend to there's only so much there are only so many things that people can remember, right?
Yeah.
And so as much as possible, people do not want to have to remember like they also do not want to have that many choices to choose from when it comes to purchasing products. I think like if I want to shop for something and I know that I've always had a good experience with Shopee or Lazada or something, then hey, I'm happy to just continue using it, right? And so I think that as long when a company has successfully captured the attention of consumers, then it becomes the company's thing to lose.
I understand.
Right? So I think that as long as, if you already have the attention of your users and you manage to continue doing the right things to attract, to keep the attention of these users, then I think your competitive position should be pretty safe.
Yeah, and saying that at the same point, is it fair for me to say that if they slack in continuing to satisfy customers, they could easily lose their lead? Would that be fair for me to say?
Yes, I would think so.
Yeah, it's always on the edge, because in a way, I was a fervent Lazada fan, and then my wife started using Shopee, and then the experience she got on Shopee, and she was telling me about it, you old school using Lazada. so
when you get like much better shipping, when you get much higher selection of products, cheaper prices, and maybe better search experience and so on, then you tend to gravitate towards like the new option, right?
Correct.
But if Lazada was still if Lazada is still like really good, and in fact if it could be better than the Shopee experience, then perhaps consumers would have stayed on to Lazada instead of
correct. Yeah. So it's this ever changing, ever constant battle, because it's this little nuances, and then it starts eating up. You don't even realize.
As a consumer, you just like suddenly, now I'm using this.
Now it's like,
no more using the other one.
Yeah.
Okay, so I think what's interesting about stock is the fact that the penetration for e-commerce only like what you're saying 9%.
Yeah.
In Latin America, I believe in the US it's already close to 40.
If I remember,
40.
globally, MJ is even lower, because we think that e-commerance is like a dinosaur, but it's actually not, because I remember
because we're privileged. That's why we think it's like
in fact, actually in the US it's in the mid-teens range. It's not close to 30%.
Oh, okay.
Yeah.
Wow.
Yeah, because I remember I think it was either Morgan Housel or no. I remember now. It was the founder of WordPress. I can't remember his name. I listened to him on a podcast. He actually said, right, e-commerce is less than 10% globally if you average it out in terms of commerce today. So it's still huge room to grow, actually.
So I think the highest penetration rates will be like, say, in China and South Korea.
Yeah.
Okay, let's go back to China. This stock is
zoom.
This stock is has been in the news for quite a bit, and that is Meituan Dianping, right? I don't know how to pronounce it correctly.
Yeah, you're pronouncing correctly.
Meituan Dianping, I don't know lah.
Dianping.
They changed. They kind of removed the Dianping name from.
Okay, Meituan.
So now it's officially known as Meituan.
So the CEO recently came out with a poem, and somehow that got interpreted as a declaration of war against the
CCP.
Chinese Communist Party.
Yeah.
And the stock tanked quite a bit. Now, before you go to that news, right, I think for the benefit for all of us listening, right, how would you describe the business model and Why do you own it, or why do you find it interesting?
Sure. So Meituan Meituan's key business right now is actually kind of like a food delivery. That's one of its key businesses, and then it also has a lot of other smaller arms where it helps connect offline services to online users, right? So like if you want to book like an appointment at a nail salon, or you want to purchase like a package at a nail salon or a facial salon or something, you can do so via Meituan, right? And if you want to purchase like hotel room stays and so on, you can also do that via Meituan. So its business is really to online food delivery, so connecting food service providers to diners and consumers,
Okay.
and as well as connecting offline services to consumers, right, to online consumers. So that is really the key business of Meituan. I find that I find it to be a super interesting business because I think it's another company that exemplifies the optionality trait. Because given the type of platform that it has, where it has just so many users right now, it can very easily introduce new services to its platform. Or how I should say this, it can very easily introduce new categories of offline services to its platform, right? And then can very easily become like the de facto or the default option for consumers when it comes to, okay, I want to look for an offline service right now. Where should I go to? Oh, Meituan, because it has so many of these things right now, right? So I think there's that dynamic there with Meituan. And that's what got me so interested in the business. And of course, when you look at the kind of growth that the company has had in terms of its business. Again, this is a company that has been compounding at a very high rate over a long period of time. So let me just, if I can pull up some quick numbers. So like if you look at, say, from 2015 to 2019, Meituan's revenue compounded at 122%, and in 2019 alone, it was still growing at 50% for its top line, right? So it's a very, very high growth business, and it's also kind of like starting to turn. In 2019, it started to turn the corner when it came to the production of profits and cash flows. So it was a very interesting business when we looked at it. And when I looked at Wang Xing, its founder, I was also intrigued because so the founder was the one that kind of made that tweet, right? Tweeted the thing that you mentioned earlier. So he actually has a long history of entrepreneurship as well, right? And so like his path towards Meituan is actually kind of winding in a way. So like he started so like the story was that he graduated from I think Tsinghua University in 2001. And then he went to the USA to pursue a PhD. And then by 2004, he dropped out and went back to China, and then started like a few different projects. So there was like Xiaonei, which is kind of like a Facebook Facebook for universities in China. Then there was like Taofang, which is kind of like a Zillow for China. And then there's Fanfo, which is like a kind of like China's version of Twitter. So it started all of these things. They had varying degrees of success, but none of them kind of really took off. And so it was only in 2010 when him and a bunch of his when Wang Xing and a bunch of his friends started Meituan, and that kind of like really took off. So I also like serial entrepreneurs, because I think that shows that I have a business leader who is driven and who wants to create, make the world a slightly better place. And I think Meituan is also unique because it does want to make the world a better place, or at least according to what the company has been telling to its investors. And when I look at the company's actions, I do think that there's some element of truth in that, right? So it basically makes, so Meituan, right, it's a Mandarin word, right? It means beautiful together, right? And so it really wants to create economic opportunities for small-time business owners in China, and wants to improve society by helping these small-time business owners grow. And so how Meituan helps them grow is to bring them an audience of online users that they would otherwise struggle to achieve on their own, right? So that's Meituan's like sense of purpose, and I like companies that have a very strong sense of purpose, because I think that this helps create motivated employees, right? And so, like, if you go beyond the bottom line, I think paradoxically, you tend to be able to get mission-driven employees who are more than happy to, really put in their blood, sweat, and tears to help the company grow. If they realize that, hey, yes, I can earn good money with this company, but there's meaning beyond just making money. So I'm kind of attracted to companies that have like this broader kind of mission. So I see a lot of that in Meituan as well.
Yeah.
And Meituan is also very interesting, right? Like so early on it had Alibaba as an investor, but I think that there was some falling out between Wang Xing and Alibaba.
Yeah.
And so what happened was Meituan actually managed to convince Tencent to invest in it.
Ooh.
And now the Meituan app is actually integrated into WeChat itself.
Wow.
Right. So I when you look at these types of strategic moves that Wang Xing has been able to pull off, I think it tells me that this is a business leader that is able to think very strategically and at the same time be able to execute very well.
Understand.
Yeah. And when you look at the way Meituan has taken market share, especially if you look at say like the online hotel industry, right? So like in 2015, Meituan's market share was only about 20%, right? But then and it was like the second largest player, so 20% market share. But by the first quarter of 2018, its market share already increased to 34% and it became the largest player. Today, I believe the market share is closer to 40 or 50%.
Understand.
Right? So, it's able to just execute really well also in the markets that it's in. So when I look at all these signs, it looked to me like this is a like kind of very interesting business that I like to own, and also kind of in a way like a proxy to participate in both the offline and online economy of China.
Yeah. Okay, good. I have a very related question to all this, especially e-commerce and actually what we call a network effect mode. Because here comes Grab trying to value itself at, I can't remember what was the multiples. And there's always this debacle in what we call trying to grab market share, loss leaders, trying to build that network effect and trying to reap the fruits in the future. So you see this in Meituan, you see this in Alibaba, Lazada, just loss leaders. You just burn money. Even fintech, I think.
Yeah.
Remember, I think you put up a chat in Kairos that I really enjoyed, the one that you talked about, Stashaway having how many employees versus Pershing Square. You remember that one?
I remember that one.
Yeah,
it's hilarious.
Yeah, that was hilarious. I pin it on my because here you are essentially burning good money to gain market share. But then how would you know whether you reap the reward in the future? Because you see all these e-commerce guys, they're telling, oh, don't worry, we'll capture this, we have the network effect, and then we'll monetize later. So in your experience and your perspective, right, where do you think, how long do you give this, one is how long do you give these guys leeway to know whether that money is well spent as a loss leader? And secondly, what are the pitfalls you see as this? And after that, do you see consolidation happen? Yeah.
Right. So so I think it depends. Sometimes like it's harder to tell. And I think it's on an individual company by company basis.
Yes.
So I've not actually studied Grab, so I can't really comment.
Yeah, me too. But I just look at the valuation, I'm like, wow.
But I think in general, like so I earlier mentioned about like I think there are good reasons why certain companies are burning cash or making losses, right?
Yes.
And so for me, I think the most important thing is trying to figure out if like this company is actually building an asset, right? That has a lot of economic value that can be monetized over time.
Okay.
Right. So I think that for me is like the
how do you quantify that when you say asset building? In your example, how do you quantify that asset? Is it user base? Is it growing user base? That's probably one, and revenue per user. Is that the metrics that you look at?
Correct. So again, it again very much depends on the type of asset that the company is building, right? So but yeah, you're right that like in some cases, revenue per user is like super important.
Yeah.
Like the dollar-based retention rates of these users, I think is also super important, right? And also like the metric like the lifetime value over customer acquisition cost if it's provided.
Yeah.
That also I think can be very useful. Of course, you have to look at what is included in customer acquisition cost to see if like the calculations to make sense.
Yeah.
But I think on a very high level, one thing that I also like to look at is I like to look at the overall like cash flow and cash flow margins. So I track cash flow margins over time, right? If it's trending in the right direction, then I think that chances are that this company is moving in the right track. But if it isn't, then it's something for me. Then I'll probably be worried as well.
Understand. Yeah.
So, what do you think about the recent news? Because I think I want to know. Because I saw it, I was like, this is another Jack Ma.
Yeah.
You know what I mean? So I think that's one of the questions people always have with investing in China is that there's always the black box or that X factor, let's call it, of the Chinese government, right? Yeah. So now with this debacle of him putting out a poem which was interpreted as going against the Chinese government, what do you think of that? Like, is that a cause for concern or is just a nothing burger?
So I think when it comes to companies in China, the Chinese government is one of the most important risks that I consider. Right. So people have asked me before, what do I think about investing in China generally? And I say that I think it's very attractive simply because the economic opportunities there are immense. But at the same time, I wouldn't be comfortable if I have like the majority of my portfolio's value in China-related companies.
Actually, just to tell you that, just so that all of us know, right? Just to prove your point, because I'm looking through your website, I think out of the 47 stocks you own, only 4 to 5 are listed in China. I mean, there's like C Limited and all that, but basically most of them are US based, some of them are Australia. So I think it ties into what you're saying right now.
Yep. So in fact, I think I have only 3 companies that are like actually based in China.
3, yes, so, correct.
Yeah, Tencent, Haidilao, and Meituan Dianping.
Yeah.
Right, Meituan. Yeah. So the reason why I'm not comfortable is because I think that Chinese companies have two entities to answer to. First would be shareholders. The second would be the Chinese government.
Yeah.
And in any conflict between these 2 entities, right, the Chinese government will win. Hands down. There is no fight.
Yeah.
Right. And so because of this, I think that Chinese companies often operate under the danger that their business growth could be stunted at any point in time if the Chinese government wants to do so.
Yes.
Right. And I'm not very familiar with Chinese politics. So I think that, so I cannot really kind of, predict what are the trigger points for the Chinese government. But even if I can predict, I also think that it's also in a way risky in the sense that you have a government that can basically do whatever it wants.
Yes.
Without any recourse. Where the affected parties do not have any recourse.
Yeah.
Right. Don't have any legal recourse. And so I think that creates a very high level of risk, I think, in Chinese companies. And in the case of Jack Ma and Ant Financial, that really blew up recently. And so in the case of Meituan, I think in general, when I look at Chinese companies, there's always that kind of risk involved. As specifically for Meituan, I would hope that Wang Xing is not going to follow in the footsteps of
he picks a different poem
of Jack Ma. It picks a different fight. I mean, he explained that the poem wasn't meant to be interpreted that way. Yeah. Right. So that's one. And he actually also had a very interesting tweet in the past, fairly recently, I think, which was that he said that something along the lines of everybody needing to, like, if you the idea was basically that you have to recognize whether or not you are a chess piece in a chess game. Right. And if you are a chess piece in a chess game, then you have to I guess react differently or act differently, right? And so I think that when I saw that, I thought that he gets it, right? Like he kind of perhaps understands where his standing is at in the grander scheme of things. Yeah.
Yeah.
And with this latest tweet, I don't know. I guess we'll tell.
That's how it is, That's just how the cookie crumbles.
Yeah, I mean, it doesn't go far from previous history because I think in USSR or Russia in the past, I think this is crystallized when I think Putin started seizing oil and gas companies that he did. Yeah, and then it's manifest itself in China. I think that's the beauty of investing. You actually just have to learn how to manage risks, and then if these are risks that you can't control, then you have to position your portfolio and size it accordingly.
Yeah, I mean, like even in the places that we are, right, like Malaysia, we all know that there's a certain limit because of certain policies. Even in Singapore, so I know Temasek is quite notorious for capping people's potential. At least that's what I heard lah. That the minute you reach a certain level and then Temasek starts to notice
to hover,
starts to take notice. But yeah, those are the. So I guess your response sounds like it's there's really nothing much you can do, and just either hold it and diversify properly. Am I right to say that?
Yep.
Okay.
That's how I approach it.
Okay.
So
or rather, that's how I'm approaching it in the portfolio.
Great. So this next stock, right? The reason I choose this stock is because I've actually never even heard of the stock before. So I was like, yeah, okay, that's going in. And that's Twilio, right?
Okay.
It sounds like Twitter, but probably not related to Twitter.
Macam yes tapi bukan.
Macam yes tapi. But so what in the world is Twilio and why is it in the portfolio?
Sure. So Twilio is a company that creates application programming interfaces or APIs that enables companies to very easily build communication solutions.
I see.
So if a company wants to have outbound communications, right, to its customers, users, or whatever, it can use Twilio to build APIs that can use Twilio's APIs to build such solutions very easily.
I see.
So what it means is that a company's software developers need not focus on its energy to create its own in-house communication software.
I see.
You can use Twilio's API, subscribe to it. So effectively kind of plug and play that Twilio software into its own IT systems, and then it can very easily start transmitting outbound communication. So Twilio enables people to serve like SMSs, WhatsApp messages, emails, and so on. So in many different types of communication formats. Yeah. So I like the company because it's API first, right? It's one of like the pioneers of having APIs, of basically selling APIs, and I think that is a very interesting business model that I think has a lot of legs for growth in the future, because I think APIs is probably the way to go. Like, you know, if you're running a company, right, you want to be up, you want to spend most of your energy, or you want your own technology team to spend most of your energy in creating solutions that are unique to your businesses.
Correct.
Like you want your employees or you want your teams to solve your business problems.
Correct.
You don't want to spend time to effort to solve issues that other people have already solved for you, right?
Yes.
So it's kind of a way outsourcing, but outsourcing in a very elegant, very simple way. Right, so you try to outsource as much as you can. I think for most business people, they want to outsource as much as they can and focus on only their core competencies. So in a way, if you are providing APIs, that's what you're doing. You're allowing other people to outsource a lot of their technological requirements, right, and allow them to focus on only their core competencies. So I like API business models, and Twilio is one of them. And Twilio actually has very strong, I think, business performance as well. So one of the key metrics that I track with software as a service companies like Twilio would be the dollar-based net expansion rate. So what it measures is really the change in revenue from all of the company's clients a year ago compared to today. So it kind of includes any customers who leave, and so it includes the negative effects of customers who leave or customers who downgrade, right? And so Twilio is a company that has consistently produced very strong dollar-based net expansion rates, right? So up to I think today, Twilio has never had a dollar-based net expansion rate that was lower than 128%, I think. So imagine, you have customers that are growing with you at 28% or more per year, right? So basically it means that Twilio's existing customers are spending at least 28% or more with it year after year after year, right? Then when you layer on an increase in the number of customers, it creates a very strong dynamic for revenue growth over time, right?
I see.
So who are these customers actually? I'm just curious.
Yeah, sure. So all kinds of companies actually. Twilio serves not just tech companies. It serves all kinds of businesses. So anybody that wants to use outbound communications can actually utilize Twilio services.
I see. Do you see any? Because I'm coming from an engineer's hat, right? So. One thing that APIs are very notorious for is that they open up holes for hackers. And I know, especially for financial services, there's always this regulation where security matters over form or factor, right? So in Twilio's case, do you see them having a struggle in approaching financial based or very high security kind of sensitive organizations that disallow them to actually just plug and play their APIs? Because APIs, as you rightly mentioned earlier, is to help solve a lot of these entrepreneurs' problem. But at the same time, by having this very open kind of APIs actually allow security breaches. Have they addressed that as a concern in your experience?
It's not something that I've taken a a lot of that I've taken a close look at, simply because Twilio is very much diversified, right? There's no kind of there's no real concentration in terms of customers as well as
I see.
industry.
I see.
So it wasn't something that I was paying attention to. Like
I see.
I wasn't thinking like, would Twilio be able to penetrate the financial services industry and so on, because I thought that like there's just a lot of other opportunities.
I see.
So but I would assume that Twilio also pays a lot of attention to the safety of its software.
I see.
Yeah, simply because if you are in charge of handling outbound communications of your customers, then you jolly well should also make sure that your systems are secure, right?
Yeah.
Otherwise, your customers may end up getting all kinds of weird communications, and
Correct.
Things will get ugly. Yeah.
I see. Yeah. Right. Thanks.
All right. So what do you think is the biggest thing kind of facing Twilio, like the boogeyman or the potential
Risk.
destroyer of the business?
Yeah.
Destroyer of the business. So I think that I kind of publish my investment thesis for every company that I come across, right? So like in Twilio's case, in the thesis that we published, I talked about 4 key risks that I see with the company that could derail our investment. So the first one will be what we call key man risk. So I think that Jeff Lawson, who is the founder and CEO of Twilio, is very important for the company's growth. So if he were to leave, then I think that would be a yellow flag, right? I would want to watch to see how the leadership transition is handled. Right.
Yeah.
So another important risk is basically competition. So earlier you asked me who Twilio's customers are. So Uber was actually one of Twilio's key customers.
I see.
Right, and at one point in time was accounted for like a mid-teens
Wow. Okay.
amount of Twilio's revenue.
Okay.
So but in 2017, Uber decided to shift away. So it kind of reduced its usage of Twilio by a significant amount.
I see.
So that caused Twilio's growth to kind of be affected. Twilio was still growing, but the growth rate became a bit lower.
I see.
So there are competitors in Twilio space, but Twilio so far has been able to continue growing really well.
I see.
And then I think Twilio is also interesting because it's one of those companies in the software space that I think has a lot of the dilution actually. So if you track its the growth in its diluted share count, I think it's increased in the mid-teens range over the past few years.
Wow.
So that's pretty high, right? And so that's something that I'm actually watching. I would want to see that the rate of dilution decreases over time. So the company actually depends a lot on issuing new shares to fund growth and to make acquisitions and so on.
I see.
Yeah, so that's something that I would hope to see decline in the future. Yeah.
I see.
So those are the key, I think, risks that could derail my investment in Twilio.
Yeah, related on that, maybe just a general concept question that I want to ask with regards to share dilution. What are your thoughts on share-based employee compensation, and to retain staff, and also in terms of minority shareholders who are outside of the company? Is it fair, or is it unfair, or is there a better way? What are your thoughts?
So ultimately, as investors in the company, what we're really concerned about is per share growth in the business, right?
Yes.
Be it cash flow or book value or earnings or whatever metric that you think is reflective of the company's actual underlying economic value.
Correct.
Right. So ultimately, you want per share growth. So in the case, if after including dilutive effects, if the per share growth in the desired metric is still at a very healthy level, I don't see any problem with that.
I see. So you will say that even if this company practices a lot of employee share-based compensation, but the dilutive effects is lesser than that of the growth, then you are fine in a way.
Yes,
okay.
Correct.
It's a bit like, for me, it's a bit like buying an asset, but you can't really capitalize it.
Yeah.
Right? To my knowledge. So anyway, that's a technical discussion.
Yeah. Or you mean like when you have a lot of stock-based compensation, you are in effect actually investing in your employee base, but you're unable to capitalize that. Is that
accounting wise?
Yeah. Okay. Now then I agree with you as well. Actually.
Yeah.
Right. So now this last one, the reason I include is because we specialize for our clients and whoever in the semiconductor industry in Malaysia, and eventually, if you study enough, it's a very, very complicated industry. But eventually, when you study enough, you will hit ASML.
Yeah.
right.
You track that path, and then suddenly you just somehow end in just a few companies.
Yeah, because
I think you end up in either TSMC or ASML.
Yeah, exactly.
pretty much. Because there are very few, like in Malaysia, there are many companies that does the same thing.
Yeah.
So sometimes that can confuse people, but with ASML, they are the only game in town from what I know.
Yeah, and the
They
competition
are the
is
only
like
game in town.
They
the
are
competition
only
is like
game in
10
town.
to 15 years behind, and
Way behind.
The competition actually publicly say they're not going to develop it because it's too expensive.
Yeah.
Yeah.
And
So
then-
your question.
yeah, my question is, and I think this is one stop of the 6 that we talk about, probably we know the most, but
Yeah.
from your point of view, right? Well, why ASML? Apart from it being the only game in town, which actually is a good enough reason, really. But we want more reasons,
Sure.
By the way, full
so-
disclosure, you own, we also own. So
Yeah, I own it.
Great,
I
great,
own
yeah.
it.
Yeah.
Do I?
We
Yeah.
are-
so.
yeah. That means we both identify greatness in ASML.
Yeah.
That's
Yeah.
fantastic.
Yeah.
So why do I like ASML? So the first thing, like you say, it is the only game in town. But more importantly, it is the only game in town for a product, the EUV lithography system, that
Yeah,
I think
yeah.
is extremely important for the technological innovations that are going to happen in the world. So for the sake of whoever is listening to this, EUV lithography stands for extreme ultraviolet lithography, and lithography systems are effectively systems that enables semiconductor manufacturers to basically print patterns onto silicon wafers, right? And these patterns, when you create enough of these patterns, they become an integrated circuit.
Yeah.
So each pattern that you print on is actually a transistor, and so an integrated circuit is also known as a chip. Right, and so basically ASML's EUV lithography system enables semiconductor manufacturers to produce chips.
Yeah.
Right, but what's unique about EUV lithography is that it enables the creation of chips that have very, very small transistors. How small? So okay, I know the term I'm using is not technically very strict. It's not a very strict technical term.
Correct.
But in effect, you can kind of just think about it as the EUV system being able to create transistors that are anywhere from 2 nanometers to about 7 nanometers. So that is the range where it excels in.
Yes.
So with lithography, the smaller the wavelength of the light that is being used, the smaller the transistors that can be printed.
Yeah.
Right. And before EUV lithography, the state of the art was DUV, deep
Correct.
ultraviolet,
Correct.
which had a wavelength of 193 nanometers.
Yes.
EUV has a wavelength of 13.5 nanometers, so it's a much smaller wavelength of light, which
Factor of
enables
10,
it to, which enables it to create a much smaller transistors, right? And so as the world as digitalization increases in the world, there will be more and more demand for chips, right? Like there's more data created and so on. You need more infrastructure to analyze the data, to store the data, and so on and so forth. All it points toward is more chips that are required, right? And also there's this very interesting dynamic that appeared in recent months, which is what is called technological sovereignty, meaning that countries in this world today want to start being able to produce more and more of their own advanced chips. So earlier we talked about TSMC, which we don't own shares in, but it's also currently a very important company in the world today because it is the most advanced and largest contract chip manufacturer in the world.
Yeah.
Right. So it has about more than a 50% market share in contract chip manufacturing. So what it means is that a lot of technology companies, they actually go to TSMC to produce their chips.
Yeah.
Because TSMC can do it. TSMC is the best at what it does.
Yeah.
Right, but it's dangerous because TSMC is based in Taiwan,
Yeah.
which is perhaps not the most
Geographically
stable region.
That's
Right?
an interesting way of putting it, but
Yeah.
okay.
Yeah, I mean, you guys know what I mean.
Yeah.
And so because of these, a lot of countries today realize that hey, we cannot have these choke points, right? We need to develop our own capabilities in terms of chip manufacturing, right? And so I think that's also a kind of a tailwind for ASML as well, because the ASML is currently like the only one that can create a EUV lithography system, right? And in fact, when you consider the entire lithography market, depending on the source that you read, ASML has a market share of anywhere from like 60 to 80%, I think.
Yeah.
Right, so it has a very clear monopoly in terms of market share, but at the same time it has a technology monopoly in the EUV space, because like you mentioned earlier, its competitors just kind of gave up. They said we cannot do it.
Yeah.
Right. I mean, to give context on why the EUV lithography system is so difficult to produce, right? So the entire system, how it works is first it requires a vacuum chamber, right? Because extreme ultraviolet light gets absorbed by everything, including air.
Yeah.
But and so within this chamber, there are droplets of tin that gets injected into the vacuum chamber, right? And it gets injected at 50,000 droplets per second.
Yes.
Each droplet is about 25 microns in diameter. So one human hair is 75 microns in diameter.
Yeah.
So you can imagine it's such a tiny droplet, and you inject that 50,000 times per second. And each time you inject the droplet, it has to be hit by two lasers.
Yeah.
The first laser changes the shape of the droplet from a sphere into a pancake.
Yeah.
The second droplet vaporizes the sphere to create plasma.
Yeah.
And this plasma is the one that creates the EUV light.
Yeah.
Right? And when this EUV light is created, it has to be guided by mirrors in a very, very precise way onto the silicon wafer.
Yeah.
Right? And the precision, and this precision, right, has to be of the light guidance it's so precise that ASML once analogized it to the idea that, if you were to shine a beam of light from Earth, you have to hit, the light has to travel to the moon and hit a spot that is as big as a coin.
Yeah.
Right. So you can imagine how precise the kind of light guidance
Alignment.
needs to be. Yeah. And the mirrors that are used in the lithography system, right, they are so flat, right, that if you were to scale it to the size of like Germany, right, there will be no bumps on that mirror that is higher than 0.1 centimeters. Can you imagine the surface the size of Germany, and it's so flat that no bump is higher than 0.1 centimeters. So that's a level of extreme precision engineering that has to go into creating an EUV lithography system. And ASML spent, so ASML started developing in 2001.
Correct.
Right? And it spent so many years developing it that it actually had to ask for capital from its biggest customers, which would be Intel, Samsung, and TSMC, right, to co-invest in the program. So it's just so difficult to do. And I think about this, like, the fact that more EUV lithography systems will be required because of the demand for more advanced chips, and also at the same time the demand for technology sovereignty. And the fact that ASML is the only company in the world that can do this, I think it's a fantastic business, right?
I'm very aligned with what you said. Being an engineer, electrical engineer myself, is like the amount of engineering precision that goes. Maybe just to give some context to the listeners, do you remember how much, off the top of your head, do you remember how much is one EUV machine? Just to give context to the clients.
So I think in 2020, the average price of one EUV system was more than about 170 million US dollars.
So just to give context to the listeners, an Airbus A320 list price is about 100 million. Of course, with discounts, you probably get it to about 80 million. So at 170, that means one EUV machine is actually two Airbus A320s. Yeah, just to give an image.
And talking about airplanes, you actually require 3 airplanes to ship one UV system.
Correct.
3 full airplanes to ship
Is
one
that
UV
big, is it?
system.
No, it's the weight because of the mirrors and a hint to the guys. The mirror company is actually starting with Z lah.
Carl Zeiss.
Carl Zeiss. Yeah.
Or Zeiss. I'm not sure.
Zeiss or Zeiss. Yeah. So it's like. This web, that's what MJ and I were pretty drawn into the semiconductor industry, because it's a very complex web. But if you separate the wheat from the shaft again, there are few very prominent players that when people see US sanctions on the surface companies, there's actually a few other companies behind it that are very B2B that most people don't even know the brand. I think
it's like an ARM level stock lah.
A lot of people don't even know ARM until the sanction, So
man. Well, thank you so much for sharing all these 6 stocks. Obviously, guys, if you want to check out more analysis from Ser Jing, head over to his blog called compounderfund.com. There, he shares all his theses. I'm sure there's more coming out, right?
We have like 47 companies in the portfolio. We have already published, I think, 44 this year so far. So there'll be like another 3 more.
Looking forward to it. Yeah. What's
over time, if we have new companies in the portfolio, then we would.
What's next? Maybe you can whet our appetite. What's next?
Next would be let me think. There will be Tesla. There would be who else would that be? Tesla, Livongo.
Livongo,
sorry.
Okay.
No, it's now Teller. It's now Teladoc.
Teladoc, yeah. Why were you so slow? No, I'm just kidding.
So I think this last question before we end the podcast is about your transition, right? Because you've always been among retail investors, and then now you've become more institutionalized with the fund that you're running. So I just want to ask you, I know you've only been running it for about 9 months right now. How has the experience been, and what are some of the things that you've learned, some of the key differences between a retail institutional investor, some of the pros and cons, things like that?
Yeah, so the experience has actually been great. So my time at the Motley Fool was fantastic. We were given a lot of autonomy to really kind of dig into the investing process.
Yeah.
But I think now with running the fund, I have even more time to really dig into the whole investing process from a professional capacity. So I would say that it has been fantastic. We have investors, I think, who also really understand what we're trying to do. And I think that has been tremendously helpful as well in terms of making the experience wonderful so far.
Yeah.
We put in a lot of effort to kind of select the right investors for the fund. So we kind of make it clear that it's not for everybody. It can be volatile. It's really long-term in nature. So we try to select investors. And also, we make it very clear what we can and what we cannot do. So, we tell investors that we cannot... The fund will be volatile. We're not here to minimize downside volatility.
Go buy money market funds if they don't want volatility.
Yeah. So we make it very clear that hey, the fund can be very easily down 30%, 40%, 50% over a month, over a year or so, something.
Yeah.
Like we cannot control that. We don't control that. And if you want somebody who can give you very consistent performance, then that's not who we are.
Yeah.
That's not what we do. Right. And also we also explain ourselves very clearly about like how we are investing.
Yeah.
Right. So we are trying to find really good companies that we call compounders.
Yes.
Right. That we think can compound their business values at high rates over the long run. And we want to buy their shares, and we want to let the fund's value be driven by the underlying business performance of the fund. It's that simple.
Yeah.
Right. But it's also not for everybody, right? I think like some investors want fund managers who can, explain very clearly to them like what's really going on in the macroeconomy or geopolitical environment right now, and who can make tactical shifts here and there and so on. So we make it very clear who we are, right? And we recognize that what we do may not be right for everyone, and that's fine. We can still be friends, right?
Yes.
But it's very important that the investor and us, we are aligned in how we think about investing. Yeah. So myself, my partner Jeremy, and we put in a lot of effort to make sure that we get the right type of investors for the fund, and so it has been a really, really great experience. Yeah, and so I think the other part of our question that you asked is you wanted to find out more about like the differences between the retail, like in terms of
the transition.
retail,
how has it been? Like some things you maybe didn't realize, but in doing institutional stuff you did.
So actually, I would say that I am still very uninstitutional with my investment fund. I try to run it the way that I would that I would manage my own money, really.
Okay.
Right. So we are investing in the exact same way that I would be doing if I were just managing my own money. So I think from that perspective, it's perhaps very uninstitutional because there's very little focus on growing the fund as a business. For us, it's really on the lowest of our priorities.
Understand.
What we're really focused on is really just investing it in the way that we know well, right? And I think so there has been very little difference in terms of like how I did it as a retail investor versus how I'm doing it from an institutional perspective as well. And I think perhaps one of the big differences between institutional investors and retail investors is like the time horizon, right? As a retail investor, or when we're investing for ourselves, we can give ourselves as much time as we need for our investment thesis to play out, or to invest with as long a time horizon as we think is sensible.
Yeah.
Right. So in my case, when I was investing on my own, I was investing with a multi-year time horizon, 5, 7, 10 years or more. Right.
Yeah.
So like when I first started investing for my parents, I bought some companies in October 2010, like Activision, Blizzard, and Apple, both of which I still own in the fund.
Yeah.
And when we liquidated most of my family's portfolio in June 2020, I still have shares of Apple and Activision, and I did not sell any of them, right? So I've owned them for 9.5 years. So I can be very, very long-term oriented, right? But I realized that is something that a lot of institutional investors don't have the luxury of, right? And it's a fascinating story that I have a few to share. So I met a fund manager who was working for a bank and investing capital for the bank, right? And he told me that in March 2020. In 2020, by the time March ended, his fund was actually, I think, like either up single digits or like down just single digits.
I
So
think it was
which
minus.
is really good already.
Yeah, I
actually.
think it was -4. You were sharing with me earlier.
-4, right?
Yeah,
Yeah,
-4.
-4.
Yeah, -4 year to date.
Yeah, that's really
Yeah, so
good,
it
really.
was phenomenal performance, right?
Yeah.
Considering the context of what stocks were doing. But
Yeah.
his bosses had to tell him to sell everything.
Everything.
Right. Everything. Right. And only allowed him to buy back in like the fourth quarter of the year.
That's
So that-
crazy, man. All the gains
Yeah, right.
are gone already.
And the reason is because like they were just so short term. They were just so myopic with like their point of view. They were like, oh no, there's like the pandemic. We're worried about the capital losses and so on. I want you to liquidate everything. Now that you're only down 4% is good. We can only we just have to suffer a 4% loss.
Safeguard position first.
Yeah, exactly. And I think that's just like one of the very interesting differences I think between institutional investors and retail investors.
Yeah.
People often think about institutional investors as like the smart money, right? But actually, I don't think that is really true, right? Right. And another interesting one. I also met this fund manager who had like 20 plus years of experience running investments for one of Singapore's a larger investment institutions.
Yeah.
And he told me, right, like he came, all of his colleagues, right, they went in as fundamental investors, meaning that they study stocks as a piece of a business,
Okay.
and they all left as technical investors, meaning that they all left studying charts. Right, so they entered as fundamental investors and they left as technical investors. And the reason is because, right, when in the company, they were just being badgered constantly about their short-term performance. Right, they're like right, and they were being measured by over 3 months or 6 months or something, right?
Yeah,
and that creates a very unhealthy mindset.
Yes.
And so this one, I think like when we were building the fund, Jeremy and I, we made it a point that that we wanted this to be a very long-term oriented fund, and so that was a message that we repeat over and over and over again with prospective investors as well as current investors, and to get them to understand that this is a project for the long haul.
Actually, that's quite interesting that you brought this up. When you meet investors like this and they don't really embrace value investing, but then when you tell them, because they look at your portfolio, oh, interesting. Okay, so I come, Ser Jing, hey, hi, I want to invest money in you, and then you tell them, yeah, it's going to be long term, whatever, right? But what they say now when it's a good time, and what they say again to you when it's a bad time, right? It's like completely the opposite. How do you handle that? Because that's something that MJ and I constantly have. They'll tell you they're value investors, they study the business. The moment portfolio drops by 5%, then they start getting jittery, and then they come to why the price went down, and they kind of how have you experienced that, and how do you handle it actually?
So two things I'll say to that, right?
Yeah.
The first is that I will try to ask them, like, what are they investing for? Are they investing with money that they need in the short run? So in fact, I tell every investor that I meet that, if you tell me that you need this money within the next 5 years, don't invest with me. Please don't. It will be very dangerous for you, right? So I think if I can kind of somehow gauge like how when do they actually need this money, then I think it helps also. I think it also perhaps help them to be a bit more long term in terms of their thinking. If they if someone tells me that they are investing for their children, and then I'll ask them, how old is your kid, right? Like, if they tell me, oh, my kid is like 15 and going to university, I'll be like, oh, then you shouldn't be investing the money.
I see.
But if someone tells me, oh, my child is like 3 years old, and then okay, cool, there's like more than a decade later before the kid enters university, right? So that's fine. Yeah. So I will try to find out a bit more about as much as possible, when do they actually require this money?
Understand.
Yeah, because if it's money they need over the short run, then I think it's I would rather they not invest in my fund at all.
Understand.
Right. And then the second thing I will speak to that is that, yes, you're absolutely right. Like, you wouldn't really know how somebody will act until the time comes.
Yeah.
Right.
Yeah.
And so I think it's also important that we as the fund manager will be willing to cut off investors right from time to time. So. Yeah, so, and I think also perhaps sometimes from the questions that investors ask, you'll also probably be able to gauge like where their attention span is at.
I understand, right?
Yeah,
that's a good point.
So it's a process that Jeremy and I are trying our best to improve over time as well. So as you say, we've only been doing this for 9 months. There's so much more we have to learn about that. Yeah. So I hope that we can improve in terms of screening our investors as time goes on.
Yeah. Probably one of the last questions for me with regards to ETF passive investing versus active investing. So over, I think it was 2 weeks ago or last week, I was listening to Jean-Marie, I can't remember his last name, Jean-Marie
Evilian.
you know.
Right, Jean-Marie. Eagle Funds, right?
Eagle Fund, the first Eagle, right?
Eagles, right?
Yeah, so it's actually very related to investor behavior and the measurement of a fund manager was because over the long period, people aren't that patient. And over the short period, as you mentioned, institutional fund managers, you know, they started out as value and then they end up short term because of this quarterization performance, right? So how do you drown that noise? Because even Jean-Marie, when he was sharing his portfolio size, it was like 6 billion at the peak, and then at lowest redemption point, it turned out to be about 600 million. So there's like a 10x reduction.
Yeah, and recently one of his students, right, Charles the Vault, I can't remember his full name. He also committed suicide because
that was really sad.
His AUM fell from 20 billion to 600 million or so.
Yeah. So. And leading towards passive investment, because here's the case. With Warren Buffett saying this, that retail investors should just go low cost index funds. In a way, that message gets translated that there is no chance no hope for the retail investor to actually do one, stock picking, and two, that you shouldn't be going for active management because the fees is too high. Because people just read the surface. Now, what is your challenge and opinion to that, in the sense that the world of active investing and the world of passive investing? What do you say to that, actually? What are your thoughts?
Yeah, so I think passive investing is fantastic, right? I think that should be the default option that for people to go to. So should start with passive investing and then decide, how much time do I actually want to devote to investing? I think that retail investors can actually still be fantastic stock pickers, right? And I think that my time at the Multifool Singapore and kind of has given me a lot of opportunities to meet individual investors who have done very well with the Multifool's help. Yeah. Right. And in fact, I would say that the Multifool's co-founders, Tom and David Gardner, they themselves, they are not like professional fund managers.
Correct.
In fact, they would very much they are a lot closer to like retail stock pickers.
Exactly.
Yeah, but they are one of the best investors that I know of, right? Yeah. They are phenomenal. Right. And so I think that it can be done. But what's important is like how much time, how much effort do you want to devote to the activity of investing actively? And secondly, I think it's important to have the right framework. Often people do not have the right framework, and then that messes their active investing up. Right? So what do I mean by right framework? So the first is, I think, having a clear philosophy about or a clear understanding of what the stock market is. So the stock market, right, actually can be many different things to many different people.
Oh yes.
But you first need to come up with an answer that satisfies your own after you have done like all the homework and your own intellectual curiosity and all that, right? So you have done all the digging and so on. You need to come up with an answer that satisfies yourself, right, about what the stock market is and is not, right? And then build an investment method that is based upon what your idea of the stock market is, right? And then the next important thing is that you must try to exhibit the right behaviors that allow your investment methods to work. Right? So I think that if you don't put in those steps in place, then chances are you will end up getting burnt if you try to actively pick your own investments in the stock market. Yeah.
Excellent advice. And unfortunately, we have to put this podcast to an end. Yeah. Hopefully, those listening are not bored. I wasn't bored.
I wasn't bored. I still have more, but like what you said, good things still have to come to an end. Yes, and probably round two.
Perhaps round two, Ser Jing, sometime in the future.
Sure, game.
Before we end, right, where can people find you if you want to be found in the first place? If you don't want, then just...
we know of some guys who don't want to come on the podcast because they don't want to be found at all.
Or they want to come on, but then they don't want people to find them.
They don't want people to find them. Yeah.
Sure. I mean, I'm happy to interact with people. I love talking about investing. Yeah, so I can be found on two places mainly. One will be my investment blog, The Good Investors. So the URL would be thegoodinvestors.sg.
Okay.
And then the other would be the website of my investment fund, which is Compounder Fund. So compounder, and then fund, fund.com.
Yeah, we'll leave the links in the comment section below. Yeah.
I can see you're not someone who wants to be annoyed on social media. That's why you never put your social medias up. Just kidding. But yeah, thank you so much, Ser Jing, for being on. And yeah, I mean, it's been a fantastic podcast. We learned so much. 6 talks, right? This is the first time we have a podcast. So if you're listening for free, this is the kind of free content, man. Okay.
So thanks for doing this. Had a lot of fun.
Absolutely. It's our pleasure.
It's our pleasure,
actually.
Definitely. Yeah. And we'll see you guys all in the next podcast.
See you guys. Bye-bye.
Bye-bye.
Bye-bye.